Hello.
Actually, you're muted, but we're going to figure this one out. Okay, that's because we have 2 extra minutes. So, great. Yep. That's because I was trying to play it off my phone really quickly. Tyler, of course, wanted Guns N' Roses. Tyler, just say hi.
Hello, everybody. Great.
Still muted, but I'll let you know.
Okay,
So
good.
we got this one, guys. All right. Well, since you can hear me, I'll be obnoxious. You can hear Tyler? We can hear him? Okay, great. Well then, Tyler, I guess we can hear you.
Oh,
Okay.
that's great.
Tyler, say hi one more time.
Yeah, hello, everybody. For some reason,
all right, I guess it's just me. Okay, so as an overview, everybody, thank you so much for joining us today. So this is the Consensio Webinar. It's the first one that we're doing. We hope to have plenty more. So just as an overview, as you guys know, right, this is going to be 3 one-hour segments, okay, and they're going to consist of the first hour. So 80% of the potential of moving averages are underutilized, even by expert technicians. So how are they used? How should they be used? Simple versus exponential. Why 2 moving averages? Why 3? Why more? What is the essence of a moving average? And what does it tell you? What information does it represent? And examples. Second hour. What is a trend? Short-term, intermediate, long-term? What does each mean? How do you recognize them? What technical tools indicate a weakening or strengthening trend? Are trend changes predictable? Always, sometimes, never. Do the duration and amplitudes of trends vary with each asset class, within asset classes? And the third hour, Consensio. So the art of understanding and reacting to incremental trend shifts using multiple moving averages of varying durations. That's right, many examples from 2007 to 2008, stock and bond markets, crypto, 2017, 2018 stock markets, 2009 stock markets, bottoms and tops in precious metals, emerging markets, and junk bonds. Okay, so how the program's going to work, and then I will pass it off to Tyler very quickly because that's who you guys came to hear, is we're going to go straight each one. So first segment, second segment, third segment, each hour. And then at the very end, I'm going to take your question and answers. Hello, little Ty. And so without further ado, Ty.
Terrific. Thank you very much. Is the volume okay, everybody? Great. This is really a thrill for Leah and me, mainly because Leah came up with this idea all by herself all the way back in January, and we didn't really get started until February. And one of the things that we wanted to try to do is we wanted to try to marry the crypto world and Bitcoin in particular with traditional investment management tools. And a shout has to go out to Tone Vase, because Leah and I would not have had the interest in this space from right now the 91 participants that are on, but a number of followers that we were lucky enough to be able to team up with Tone Vase. And he was generous enough to share huge amounts of knowledge with us. So if Tone is on, thank you very much. We owe an awful lot to you. The next thing is we owe a tremendous amount to the people on Twitter and YouTube that have taken the time to listen. And I get a kick out of the fact that a lot of you love to put our YouTube on 2x, meaning the speed with which we go through it, because as you all know, I speak very slowly sometimes. And I try to choose my words and my conclusions very, very carefully. So if anybody wants to play this back, just you can speed it up to 2x. 3 hours is not enough time. It's not nearly enough time to cover what we're going to cover today. So I'm going to go through parts of this very, very quickly. But I wanted to spend a little time just talking about the fact we're going to talk about one technical tool today, which is, we call it Consensio, which is a fancy way of saying silly moving averages that everybody in the world has used going all the way back to 1920s. However, I recognized fairly early how underutilized they really were. Now, what Leah just told everybody is that this first part, we're going to be talking about moving averages and lines and charts. And we're not going to really get too deeply into Consensio until we get to the end of this first hour. We'll take short breaks between the hours, just a couple of minutes each, so people can get up and stretch, and I can do the same thing. But this is going to be pretty nonstop. If you don't have pencil or pen and paper, this is the time to get it. There's going to be an awful lot of detail, and I know that it will be helpful not just right now with what's going on in the marketplace, but very hopefully for years and years to come, because it's one of the most powerful tools I have found in recognizing trend changes. And that's what we're going to talk about in the second hour. What is a trend? And what does it really mean? So before I get into those kind of things, I just wanted to hold up a couple of things. This is a book. It's actually a part of what Edson Gould wrote back in the 1970s in his group called Findings and Forecasts. And this is called The Vital Anatomy. This was written before many of you were born. And I could show you the same thing from the 1920s and the 1930s and the 1940s. People that recognized what really moves markets. And one of the best ever is this gentleman, Edson Gould, Edson Gould. You can write that down and then Google him. And what I wanted to do is just read something. I've got 4 little pamphlets here that I pulled randomly out of a box that's in my office that has another 150 of these kind of things. And then I've got another 100 boxes full of these, plus my own research going back many, many, many years. Unfortunately, I just moved not too long ago, and so they're still in boxes, including a lot of work on hyperwaves. So I'm also grateful for a number of the people that are listening right now who come from our hyperwave research group. I had nothing to do with forming that group. They did it themselves under the leadership of a half a dozen brilliant people. We now have pushing 40 people in the group. And what they're doing is constantly looking for hyperwaves around the world. Many of them are doing it so they can trade them, but many of them are doing it for the analytics involved. And that saves me and everyone else a lot of time. And I'm very, very appreciative of that group. Okay, this is back in the mid-1970s, what Edson Gould said about his whole structure. I will just read you a very quick profile. You'll find a lot more if you Google it. But although formally educated as an engineer, Edson Gould found his way to Wall Street at an early age. His association with John Moody, Moody's Investor Service, which of course is still one of the big 3 services today in the bond world, back in the 1920s and 30s, afforded him valuable training as a security analyst, account executive, editor of Moody's Stock Survey and Moody's Bond Survey, and head of the economics department. As former senior research partner at Arthur Wiesenberger and Company and investment committee chairman of Nuveen Corporation, Mr. Gould is one of Wall Street's pioneer technical security analysts, having put together the first glamour average back in 1960, at that time encompassing such little or relatively unknown stocks as Xerox, Syntex, Polaroid, and IBM. Articles by, interviews with, and quotes from Mr. Gould recently appeared in such leading financial publications as Wall Street Journal, Barron's Business Week, New York Times, et cetera, et cetera. Okay, so he's the real deal. But I hope you caught the bit about technical analysis. The reason I glommed onto him back in the 70s is because he married fundamental analysis that had gone back to the 1920s with his work in the 1950s, 60s, and 70s. And here is his group called Findings and Forecasts. Here is their philosophy. And this is a lead in to our first two parts, one on moving averages and one on trends. He says, it has been said, making money in the stock market is not that difficult, but keeping what you've made is. It is our firm belief that most investors give back their stock market profits time and time again by making a continuing mistake, ignoring the importance of overall stock market trends, especially primary, intermediate, and long-term trend reversals. Now, this is before John Bogle and Vanguard and Wall Street begin telling people what you want to do is buy and hold, because eventually it's going to work out. And I've never bought into that from when I first began in the mid-1970s, and that's why I began following people like this. This little pamphlet is one that I picked up in the early 1970s called the Cherry Book. And the reason I bring it up is because it's so unusual, and it got me started in what I've done for the last 40 years. The Cherry Book is the insider's guide to intrinsic value of common silver coins of the world at silver bullion prices of $2.50 to $5 per troy ounce. Well, I came across this in the very early 1970s. Remember, 1971 is when Richard Nixon closed the gold window. Silver was tied to gold, and gold was pegged at $35 an ounce. And what people did not realize in the early 70s, as gold went from $35 an ounce to up to $200 very quickly, and then pulled back and then ran up to $800 9 years later, that silver was doing the same thing, running from $1.65 to $2, and then finally up to $40, and then all the way back down. Why do I say all the way back down? Well, you know what I have said about hyperwaves. Both gold and silver turned out to be in a hyperwave. But I got very interested in silver and silver coins in 1971, 72, 73, and 74 because of this little pamphlet. You can turn in this pamphlet to any random page. This is Honduras between 1931 and 1967 with all their coinage. And the next page is Sweden, and the next page is Canada. All around the world, taking the silver coins and telling you at what point, $2.50, 60 cents, 70 cents, that the price of the coin was worth less than the silver in the coin. And I thought, wow, this is great, because I'm beginning to see that prices of gold and silver are going to go a lot higher, and I'll bet not a whole lot of people around the world know that the currency, this change in their pocket, is worth more if they don't spend it on anything. And so I went into business while I was in the Coast Guard with the captain of the port. I was the chief executive officer in Honolulu. And what the two of us did is we ran ads in the newspapers telling everybody, if you've got silver dimes, quarters, half dollars, silver dollars, bring them to us, or we'll come and we'll pick them up, and we'll give you 1.5 times the value, face value of your coins. What we didn't realize is the Japanese that had moved to Hawaii after World War II and in the 50s and 60s, and opened up mom and pop shops, had the inkling that the silver in silver coins someday would be worth a lot. And so many of them, hundreds of them, began putting them in safety deposit box in banks all over Hawaii. And we didn't know that, but all of a sudden our phone was ringing off the hook with people with $100, $500, $1,000, $10,000 worth of dimes, quarters, half dollars that were silver. And so we would walk in and we would pay 1.5 times what they thought it was worth. We had already sold it back in Los Angeles that same morning at 2 times face value. And we did that for 3 years. And I used that money, I had no money at the time, to buy my first condominium. The reason I point all of that out is, without going into a lot of detail, but we found that large institutions, banks, currency exchanges in airports, casinos in Las Vegas, didn't realize the value of all of their bags of silver coins. So we could walk in and we could buy them for a lot less, 25% less, and still make a huge profit on it. And that lasted until everyone caught on with what was going on. And then, of course, that was dead. So keeping your minds open at all times when you start dealing in assets will lead you to be able to recognize things that even people in the business don't recognize. And I talk specifically about that relative to what Wall Street has told you is true, without you asking the question, why are they telling me that? Or why a hedge fund manager coming on to CNBC and talking something that they believe in, you have to ask the question, why are they telling me that and this audience that? So you have to be very discriminating about what you assume to be true. And the most obvious things very often are overlooked. This little pamphlet, called The Long-Term Trend of Volume, was written by my partner back in the late 1980s. I had a company called Cannon Block Carre that I've talked about before. We were in Boston and we studied mutual funds. Why? Because nobody was studying mutual funds. The only thing you could ever find out about mutual funds, and I talked about this in an earlier vlog, is what did they do last year and 3 years ago and 5 years ago, but nobody analyzed them. Why were they doing that relative to indexes and other mutual funds? And so we put together a company, and that's all we did, but we did it also on a technical basis. And this gentleman joined us. His name was Walter Stone. He's one of the best technical analysts I've ever met. I was privileged to work with him for 6 years, but this whole booklet goes into decade by decade, the volume relative to the Dow Jones Industrial Average, going all the way back to the late 1800s. And he did everything by hand until computers came along. He went crazy when the first Macs came out. And because all of a sudden he could do all these analytics. Up till that time, every day since the 1950s, in other words, 25 years, he kept all of his technical charts by hand, pencil and paper, at the end of every day's trading on Wall Street. And we're not talking about just the price. We're talking about 50 different indicators, several of which he had invented, many of which had to do with volume. So I began to see and understand how volume actually works. You don't hear about it too much today. Finally, I picked up this one randomly, which is my favorite publication of all times. It's just called Cycles. And it's very difficult to find anybody talking about cycles. This particular one was published back in 1989. But for years and years and years, I received this monthly, looked forward to it because of what it included in it. There's one article that I thought was fascinating about a thing called a 9-year cycle. And in this article on a 9-year cycle, which I hadn't heard before that, nobody talks about now, the person that wrote it listed about 15 different major cycles that have nothing to do with the financial markets. They have to do with things like church membership and sunspots and agriculture and growing cycles and heating and cooling cycles. The things that people throw around today having to do with global warming and all of the rest of it. This is what the article looks like. You can just see some charts. That's a 9-year cycle on the one page. Now, the people that contributed to this, to people in technical analysis, you know all of the names. I'm just going to turn to the front because the board of directors, the chairman is a fellow back then by the name of Peter Borish. Peter Borish, most people don't know, was Paul Tudor Jones's chief researcher at his hedge fund for years. And I got a call from Peter Borish. I didn't know who Peter Borish was until he referred me to this magazine that I'd been reading for years before that. And he called me up because he saw an article about hyperwave that was written in the San Francisco Chronicle and made the front page of the daily newspaper with a chart of a hyperwave, which was back in 1989, which is one of the only times I'd ever talked about hyperwaves publicly. But I was flipping through this one on my way over here, just looking at the names: Robert Prechter, Jim Tillman, Ray Merriman, Peter Eliades. Peter Eliades, for those of you who don't know, is one of the eminent, with an E, practitioners of technical analysis, has been slightly longer than I have. And he spent a lot of time on television out in Southern California talking about a thing called speed resistance lines. And speed resistance lines, going through Edson Gould's book on my way over here, I was just flipping through it. And back 10 years before, 15 years before this, Edson Gould was talking about speed resistance lines. Most people don't know what they are and don't use them today. Okay, too much time, but it's important for you to hear me saying, as you have in many of my vlogs, that all of these things tie together. We're going to talk about one of them today, and we're going to do it by going directly to this thing that I call Consensio. So I am going to share with you this picture. That is because I am the president of Lucid Investment Strategies. And now I want to share with you this picture again, because I am still president of Lucid Investment Strategies. Now, somehow, what I need to do, and here comes my assistant who knows these things where I do not. And there we have her. Thank you. That's my son Tyler, who runs verypossible.com with Leah's brother. And that's backstory that some of you know, and someday I will tell it to everybody, but that's how we got into this whole thing. Okay. You've seen this chart before, and this is the beginning of what we want to talk about today, which is what is a moving average and how does it work and what does Consensio mean? And what I'd like to do is I would like to have you mentally begin picturing some things. First of all, I want you to think of every chart you've ever seen having to do with stocks, bonds, ETFs, commodities. They all have two similar aspects to them. One is an x-axis and one is a y-axis. Along the bottom of the chart is almost always time. And along one side or the other is almost always price. Now, you learned in simple math classes that that is only one quadrant of reality, and it's the plus quadrant. In other words, if you are looking at a full graphic where across the bottom is one axis and my other arm is the other axis, in the upper right-hand quadrant are pluses. You go from 0 in the middle where the two lines cross, and you go up either price or it could be anything else, but along the bottom axis, you go from 0 out to some number, which is time. And that's where in the financial world we do all of our plotting. There's huge implications to that fact. One of them is that everything moves from the 0 line in the middle or on our quadrant, the plus quadrant. From the bottom left corner, it always moves to the right. Why? Because time goes by. And that means you can do certain things plotting time against price in that quadrant, but you can never get the line to go completely horizontal or flat over time unless price does not change. That flat line becomes what is called a trend line. And what you need to understand in this first hour is that all lines on a financial chart are not equal. The strongest lines on a financial chart are horizontal. If price is changing over time, you will get an angular line. And that angular line is not as strong as the horizontal line. And what becomes important is the angle of that angular line can only move through certain degrees. It can never go up to 180 degrees relative to the timeline. And of course, it can never go to 181 degrees because that would mean you are going backwards in time. So as you always move from the left-hand side lower of a chart across the chart over time, you are limited into what those lines can do, what price can do. We won't talk about the other three quadrants because they're theoretical and it works for mathematicians. It also works in the practical world that if you are going across time and you've got X amount of dollars, you can move into the lower right quadrant by losing money. You can go below zero. You can't do that in the investment market because if an asset drops in price down through the zero line, it's out of business. You can do it with your budget and you can do it using credit, but an asset can't do it. If a corporation's price drops to zero, that corporation is out of business and therefore you don't have to look at it. Simple observations, but they have tremendous meaning when you look at charts. Particularly when you start doing things to those lines. I'm not going to talk hyperwave today. Those of you who have looked into hyperwave through our vlogs or heard me talking about it knows that what happens is you start out with what is called a phase one line, which is a horizontal line. And the reason it's so important in hyperwave is because it's the most powerful line because it's horizontal, and that restricts price over many, many months, quarters, or years before anything happens. And it's also the thing that attracts price back to it at the end of a hyperwave. All right. But a horizontal line does a lot of other things when you look at things like Fibonacci numbers. Fibonacci lines are horizontal. And I've already said that those lines are more powerful than angular lines, which can be trend lines. Most trend lines are angular. They move from left to right, but they can move from high to low or from low to high. If they rest somewhere in between high to low or low to high, they become horizontal. And that's why those of you that have listened to us about Bitcoin, we identified very early two very important horizontal lines. One was at 10,100 on Bitcoin price, and the other was on 11,100 on Bitcoin price. Okay, back to screen share, hopefully, without me bringing up the presidential picture. Boom. All right. What we're going to look at today are, in this particular case, only two moving averages in price. Now, I've shown this before. We did an entire vlog on it, but I want to go through it very quickly to show you why I came up with this thing called Consensio. Consensio, as Leah had talked about before, means agreement in Latin. And what we're looking for is we're looking for prices, moving averages that come together or agree with each other at a point in time. and I'll explain why that is. But for now, let's just quickly go through what we're looking at. We're looking at a short-term moving average, a long-term moving average, and price. The short-term moving average, unfortunately, is a light blue color, and so it gets lost as we come down, and you can't see it here, and then it goes up. But you can picture it mentally, and I'd much rather you picture it mentally than looking at the picture. What you're looking at is what is called a sine wave. And that simply means that if you graph the sine in trigonometry, it has a wave-like function to it, in which if you draw a horizontal line at the 60 level here, you start at one point, you move up at a certain percentage rate, you come the same percentage below that midline, and then you get back to the midline. You keep repeating that forever. I chose this as a way of explaining Consensio because it's the best way to get into what we call the subconditions of Consensio. And the subconditions of Consensio are made up of A, which is what you're looking at here, and this is a bull market. When you are in A, you are in a bull market in Bitcoin, in the US stock market, in gold prices, in anything that anyone studies where you're going from left to right against an X and a Y axis with price on one side and time at the bottom. That's a bull market. That can last for many years. We've been in a bull market, the longest in history, right up through today. We are still in that bull market. When we talk about Bitcoin, we know that Bitcoin did this also. It took it 10 years to get to where it was going. Along the way, we had a couple of bull bear cycles, then a very big bull cycle, and now a very big bear cycle. That doesn't matter to this analysis. And what certainly doesn't matter is the name of whatever it is you're looking at. They're all exactly the same. I'm sorry for those of you who continue to believe that Bitcoin is something other than the other 200,000 asset classes and sub-asset classes that all technical analysis works with. It is simply another one. Okay, that's condition A. Price, the blue line, is above the intermediate term, which is above the long term, and the short term is above the long term. They're all going up together. This on the far side, and we'll get to it in a very quick second, is another bull market. So we're looking at two bull markets, in between which is a bear market, in between which there is all of this confusion there and down here. What Consensio attempts to do is get you out of a bull market long before the bear market has started, and to get you into the next bull market, but not long after a bear market has ended. And I'll explain why I just said that as we go through this over the next 3 hours. Okay, what I would like to do now is take a look at subcondition B. Subcondition B must always occur before you go from a bull to a bear market. You can't get into a bear market without doing subcondition B. And subcondition B simply means the price is the same as the short-term moving average, right here. This blue line that you can't see, and the price are at the same point at the same time. In the popular vernacular, price is cutting through or crossing the blue line. That is B. You can't go to C without going through B. What is C? C is price is now below the short-term moving average. It was on it, it's now below it. Price is still above the long-term moving average, and the short-term moving average is still above the long-term moving average. So just at one point in time, you have that point A. Now you're in point B and then point C. Point B, they touch. Point C, they cross. And then point D. You notice that I am not talking about time periods. I haven't told you the length of the moving averages. They don't matter until you have picked your asset and until you know, are you a gambler, a speculator, or an investor? You can be all of those things, but not if you're using Consensio for making a decision unless you predetermine how long you intend to hold this particular asset. We will get into that in a lot of detail in the second part when we talk about trends. What I want you to picture is what this is telling you, the story it is telling you, referring back to what Edson Gould said. If you remember what he said that everybody can make money investing, but very, very few people can hold on to it. And the reason is they don't understand the difference between short, intermediate, and long-term trends. What I'm now showing you is a way, very mechanical, that you can absolutely identify the trend, short, intermediate, or long, and move from a bull market out of what you were in a step-by-step fashion and protect yourself from what Edson Gould, after 40 years, realized was the biggest problem with investors. Subcondition D, the price is below the short-term moving average. We've seen this over and over again in the last 2 weeks. Many of my clients, our consulting clients, have been asking, doesn't that mean I should be taking something off the table? And the answer is yes. But if 10 people ask me that question on the same day, I might go yes, yes, no, 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 yes, yes, no, yes, no, yes. Because it is dependent on what you as an individual are doing with that asset. Are you jumping in and out of it? Are you holding it throughout a long-term trend? And that has to do with the time periods that we're going to talk about in great detail later. Okay, price is the same as the long-term moving average now. In other words, the price has been coming down, the short-term moving average is flattened out, and the price has now touched the long-term moving average. And on, without looking at all of them, because we've got lots more to cover. Condition E, F, G, and what is going on in G now compared to what we were looking at A. Price is below the short-term moving average, price is below the long-term moving average, and the short-term moving average is now below the long-term moving average. Notice that the long-term moving average has only at the beginning rolled over and started turning down. Each of the steps that we're talking about now have to follow and or precede the steps in front of them. Now we've just run from all the way up here on the chart at whatever price, depending on the length of your moving averages, you wanted to get out of this uptrend. You are out back on subcondition G. And look what happens in subcondition H. You're in a bear market all the way down until that bear market begins to change. And finally, in this idealized way of looking at what Consensio is attempting to achieve, we begin up the other side until everything is crossed over and you're back out of a bear market and into a bull market. Now, that's all we're going to do with those lines at this point. Those of you who have gone back and looked at the vlogs, and thank you for doing that. We get a number of people that call us and said, we didn't want to contact you until we had watched all of your vlogs at least 2 or 3 times. And that is music to my ears. We have been more than happy to make those available to as many people as wanted to for free. And now we're going to start going into in-depth on some of the concepts we've talked about. Not because we are money hungry, but it's the practical way for monetizing what Leah spends so much of her time doing without getting any sort of remuneration. But more importantly than that, a 3-hour, I can't do a 3-hour vlog just on Consensio. This one could go 10 hours on Consensio. I think we've been able to get it down short enough that you will know everything you need to know about Consensio. And we've got another 6 or 7 of these planned between now and the end of the year on a number of different subjects. One of them, unfortunately, is not going to be hyperwave, because we are going to introduce that as a tip of our hats, our collective hats, to Tone Vase. We will do that during his January conference that he's starting for the first time this year. And that will be the first time in 20 some odd years I've made it public in a general way. And I think that's the right place for us to do it. But all of these other topics that we're going to be talking about in great detail between now and then, I think you're going to find very interesting. Okay, we are already 12 minutes away from the end of the first hour, where we have talked about perspective, first of all. One of the things about going on TradingView or Stock Charts or Bitcoin Wisdom or a lot of places you can go at Fidelity or E-Trade to look at price, you can click a button and a technical indicator will pop up against what you're looking at. And some of you have spent a lot of time trying to understand what those indicators are. What I wanted to give you a little bit of a perspective on is that each of these indicators have been built on the backs of other indicators going all the way back close to 100 years. And each thing, the Gann angles, if you look on all these charting services, the Elliott waves, all of those came in the 1930s and 40s. Charles Dow came up with the Dow theory in the late 1800s. Roger Babson has a brilliant book that he wrote along with 4 or 5 other books in the 1920s, Babson of Babson College, but of many, many other things, that has charts in great detail the way Edson Gould had charts in what you looked at from the 1970s. He was doing that back in the 20s. It's difficult for us today to look at something by pressing a button and overlaying something that someone else did by hand over years and years, and then someone else came along. Let me give you an example in terms of the sequential trading system that Tone Vays has changed off of the TD trading system that Tom DeMark changed off of the original, which came from Larry Williams back in the 1970s. And along the way, there were improvements made. I don't think anyone improved it the way Tone Vays has, because he's added other things to it. Now, you can either spend time doing that yourself, and many of you are doing that. Many of the listeners, we've got 100 people on right now. Many of you are very interested in understanding these and spend more time than I do looking at these technical indicators, not only intellectually and academically, but so they can figure out how to manage their own money. And they're using a lot of these techniques to do it, some very, very successfully. And that's what I hope everybody gets out of this. Those of you who started listening to us only because of Bitcoin and crypto, which is how we got into this, but many of you are a lot more experienced than a lot of the people who are only in the crypto space. Not because you're smarter or more intelligent, but basically because you're older and you've lived through things like 06, 07, 08, some of you through 2001, 2, and 3, in which you had money on the line and only realized after the fact that Edson Gould was right. And if you didn't know what Edson Gould said, or you hadn't experienced it before, such as in 1987, the stock market crash, or after 17 years of the stock market not going anywhere from 1965 to 1982, you didn't get in at the beginning of 83 or 84 or 85 or 86. And you didn't get in at the beginning of the 90s. And you didn't get in until 95, 96, 97 had proved to be the 3 biggest years in a row in stock market history. And now you read it everywhere and everyone was talking about it. So you got in right before the stock market crash, the dot-com bubble crash in 2000. And back and forth throughout time in your experience. What we found with people in the crypto community is they tended to be much younger, got very excited about this very, very exciting asset class, but couldn't wrap their heads around the fact that all these traditional things that Bitcoin was standing against and attempting to improve upon was actually, many of them, going to affect Bitcoin as another asset class. And we find ourselves in the middle of that right now. Okay, so the reason I'm going through all of that is I've just outlined to you one system called Consensio that you can't really grasp what it's doing just by looking at the wavy lines. It's important that I have stressed that in this sine wave that I have shown, that had from A to M to go through a whole cycle, step by step, you will almost never find that in the real world. It's simply an artificial construct that I came up with to show how you need to think about a trend change. As soon as you've added a third moving average to the two that you just looked at in an ideal situation, you go from A, B, C, D, E, F, G, H, I, J, K, L, M, 13 iterations in the perfect world, up to many, many times that in the real world. And early on, when we presented Consensio for the first time, I challenged everybody, add one more line, which we'll call an intermediate term moving average. What we just looked at was just price, short term and long term. If you add something between those two moving averages, I asked you to calculate, if you could, the number of iterations it would take to understand what was going on from between a bull market through a bear market and back to a bull market. And many of you guessed 35, 36. Some came closer at a couple of hundred. A couple of people got up as high as 400 or 500. We found that there was well over 1,000 different iterations just by adding that one line. And if you go from a perfect sine wave construction, which almost never occurs in the real world, to the real world where each part of that sine wave can be extended, can drop sharply, can move to the left sharply, never to the right, because you can't go back in time. But it always moves from left to right, but there's still 1,000 variations. So the way you marry this confusion from simplicity to what we've just talked about to certainty, which we will get into the second hour when we start talking about what is a trend. What does it really mean? We throw the terms around all the time. So with that, we're going to take a break. We've got a couple of minutes before the hour is up. What we're going to do is we're not taking questions during this 3-hour period, but we've got 45 minutes or an hour after the 3 hours are over. And Leah is working very diligently behind the scenes to put these questions together, things that I have misstated or stated what I thought was correctly, but some of you want to challenge it or ask questions about it or would like me to go into more detail about it. That's what we will start doing when the 3-hour period is over. And with that, I'm going to take a short break and be back. And if you want to, you can do the same thing. So thank you very much. I will be back shortly. And have been expecting a trend change after 10 years. So what better way to go through the next month than applying what you're hearing today? That's what I will be doing with all of our consulting clients. That's what I am doing with all of the clients where we manage money on a fiduciary basis. I do it anyway all the time, but at certain points over the last 10 years, it's become critical because you go through pauses in a trend. And when you go through pauses in a trend, there is no better tool to understand what the probability that the trend will continue than what you are learning today. All the other momentum indicators, all the things you hear me talking about that Wells Wilder came up with, all of the other charting techniques, I find not as powerful as the one I'm teaching today. So let me just see how the weeklies closed in terms of some markets for those of you who for the last hour have been wondering how the week would close, because we use weekly closing prices on much of the work that I do. S&P came back nicely. The NASDAQ was up almost 3%, 277. Even the Dow, which had been up 400 points earlier and went negative during the day, closed up over 1%, almost 300 points. It's settling up now. Let me just take a look at a couple of quick other things, such as gold down 0.5% after that tremendous move yesterday. Okay, so things are still in line with what I've been saying on Twitter. We apologize for not doing more vlogs, but Leah spent a wonderful period of time in Southern California and then in Northern California, except for when I would bug her about doing all the work she's been doing, making sure that this went smoothly and as many of you as possible could get into it. We're very happy that there's still 105 participants. I thought as I droned on and on that would drop down to about 20. Maybe a bunch of people dropped out and new ones came in. I'm trying to speak as quickly as I can, so excuse me for that. All right, let's get into let's see if I can figure this one out now. I think I can. We want, oh wait, I think it's this one right here. This one. Can you see that, everyone?
Not screen share yet, Ty.
Oh, I can see it. So that's all that matters. Okay. So I bet if I made this small and then I did this again, and then I do this, and then I make this big. Can you see that?
Yep, looks good.
Touchdown. Okay, I only could do that because my son spent 2 hours showing me. Tone Vase and our friend Sweet Pig helped me last night. Okay, what you are looking at is the Dow Jones Industrial Average from left to right. Remember what happens on the chart. You cannot go vertical. You can only go angular or horizontal because at the bottom of the chart is time. Everybody is very excited about this. I was very excited about this because this was a breakout to new all-time forever highs on something that I have studied price going back to the late 1800s. And this little beauty right here is the highest, biggest that there has ever been in the history of the stock market. A lot of people are nervous because of this. So let's take a look at what a trend really is. Now we're going to go back a couple of years. This is clearly a trend. I said it can go from the bottom left either angularly up or angularly down or angularly up. It cannot go straight up. It can do it for a short period of time, such as when this became the highest ever, but it can't keep going straight up, and it can never go backwards. It just seems so logical. Of course it can't go backwards, but understand why it can't. Because this is 1/4 of a quadrant that is plus plus. Over on the other side, to the left of this chart, is a quadrant that is plus on price, but negative on time. And below this chart is the quadrant that is positive on time, but negative on price. And horizontal to this, if you could take this trend down off the chart into a lower quadrant, everything is negative, time and price. Obviously. But why is that important? Because you're trapped. You're trapped in this little quadrant in which only certain things can happen, which explains why every uptrend ends. Show me any uptrend on a quadrant that's plus plus like this one that has gone straight up and kept going, or gone up at an angle and kept going, like General Electric, for example, that did it for decades and decades and decades and decades and now is crumbling into nothing. Was taken out of the Dow Jones Industrial Average after almost 85 years just recently. There are those that believe that Bitcoin will only go up and up and up and up. That will be the first time in history that's ever happened. So let's go back a little bit further and talk about what a trend really is. Now we're going back to a little problem area in which clearly we were flat. We tried to go down, we tried to go up, we tried to go down. I love this little button. And then we tried to go up, and then we went flat, and then we finally went up and a new trend started. This is a flat. Well, you say, no, it's not a flat. It keeps going up and down. I can make money going up. I can make money going down. I can make money going up. So you have just defined yourself as a speculator or a gambler, but not an investor. An investor can't make money in this market. An investor can make a lot of money in this market. So let's go back even further. We're looking at just one chart, the Dow Jones Industrial Average. Now we're at 2013, and we see one trend. It's up from the bottom left to the upper right. That is a trend. But I'm defining that trend from the point of view of an investor who doesn't want to jump in and out of things, but wants to know when is a trend going to be, according to Consensio, one that can go on for many months, quarters, or years, in which you don't have to watch the charts every day. You don't even have to watch them basically more than once a week, and you can do that very quickly by simply getting rid of the price and using the moving averages, which we will demonstrate in just a second. Now, this particular chart is beginning just back in April of 2012. We had just come out of a tremendous downturn that we could look at if we wanted to look further back. If we do this, remind me that I want to take that off because I've just changed 75 charts. You've still got a trend from the bottom here which is the end of this tremendous downturn. It really didn't last very long, but was hideous. And this downtrend, which also was hideous, but lasted a long time, lasted 3 years, from March of 2000 until March of 2003. But other than that, if you come to this side of the chart, 1991, you've got one trend, which is an uptrend. I could go back to 1900 and you will see this same trend for the Dow Jones Industrial Average. From the bottom left to the top right, always going higher and higher. There are those that believe, I am not one of them, but there are those that believe that because this trend is so apparent over many, many, many decades, that should be the only way you look at investments. Buy and hold good stocks, good mutual funds, good ETFs. And that held pretty true in most of our lifetimes. But Edson Gould said 25 years before this chart that the problem is people don't recognize the difference between long, intermediate, and short-term trends. So they go through periods like this. That last 10 years in this case. And we will see later on the NASDAQ, I've shown you that lasted a lot longer, lasted till just a couple of years ago without getting back above where it was. I would look at this chart and I would say there's some great opportunities from 1990 to 2000, 10 years uninterrupted with this little squiggle down here, which was basically the Malaysia currency crisis along with long-term capital hedge fund basically blowing up and almost bringing a lot of banks and brokerage firms down with it. But even after that little diddly doodle, we still ran up in one of the biggest surges in stock market history. At least it was for the NASDAQ. Between 1998 and the year 2000, and that last year, 1999, the NASDAQ was up 84% in 1 year. And if you had gotten scared out because of this, you wouldn't have had that ride. If you hadn't gotten scared out and didn't realize what this was doing, remember, it was March of 2000 where the NASDAQ peaked. The Dow kept going sideways months and months and months after the NASDAQ peaked before it dropped down. So I would look at this and I'd say there's one trend here, there is one trend here, which is two, there's a third trend here, a fourth here, and a fifth here. 5 trends. And you needed to play all 5 of those if you were perfectly attuned to investment, the optimal investment rules. You would be in, out, in, out, in, and still in today. And I will try to explain why and how I am making that comment. I said that you need to be able to define what you mean is a trend for who you are and what you're trying to achieve. I put what sounds like pejorative words on top of that. To me, gambling, talking about people trying to make money in the market, is not a pejorative term. It simply means that you're willing to jump in and out and in and out and in and out of positions. You cannot do that fundamentally. You have to do that technically. And you can choose your tools to do that with. And that's fine. You're basically flipping a coin, and you might get 6 in a row correct, and then 6 in a row not correct, or you might every other trade make money or lose money. So even though you're talking about a 50-50 proposition most of the time, you can make a lot of money if you learn money management, which is the size of your positions and the amount of loss you are willing to take compared to the amount of gains you are willing to wait for. That has nothing to do with technical analysis, and it has nothing to do with the size of the trends. It has to do with your ability to manage what you are doing using proper sizing and stop losses or other defensive tools that we will do an entire show on, a webinar at a different time. Okay, now what I need to do is I need to try to clean up my charts so that I don't irreparably screw up everything we've been trying to build. And we will do that by, first of all, leaving the monthly and going back to the weekly. The weekly to me is everything in analysis, mainly because I got married to it with my work in hyperwaves over the years. And since then, it's changed almost everything I do in terms of charting, where I wait for weekly closes. This is the current week we're in the Dow Jones Industrials. And you can see that we dropped down much further than we closed. And so we've got a little bit of a wick. Still, it's not a reversal, and it's a very negative close for the week. But we will break that down as we look at all the other charts. Okay, now what I'm going to do is I am going to put back on the moving averages. And I'm going to start with this itty-bitty one, which is the most confusing of the ones that I use, and a lot of people ignore it. This is a 3-week moving average, which doesn't tell you anything, basically speaking, as you look at it relative to price. And the reason it doesn't is because we're not talking about perfect sine waves. And each of these candles, depending on the size of it, will go well above that 3-week moving average or drop well below it. But it's important for me and Consensio because my very, very short-term averages that I use is the thing that makes me sit up and take notice that maybe something is beginning to happen. As long as price is staying within, above and below those averages, as it's either moving up or down, as it does in almost every case here, meaning each of the candles is touching somewhere on that pink line, then the pink line is doing what I want it to do. When you start getting candles above or below a line, then you are buying inefficiency in terms of what the line is supposed to be telling you. I needed to know on this kind of a move that the pink line was going to turn down. And just think about that for a second, what I'm trying to explain. And one way I can explain it better is to take that one off and go to the next biggest one, which I'm using, which happens to be a 7. Now, what you will notice when I just move out 7, in this case it's weeks, in terms of days on a 5-day business week asset. A 7 is equal to 35 days. On a 7-day asset like Bitcoin, I drop down to a 2 because a 2 equals 14 days, whereas a 3 on a 5-day is 15 days. The thing that makes me change a moving average is its relationship to price. I don't want any moving average to be so far above or so far below price as to be useless. Therefore, when I change from weekly to daily or 4 hours or monthly, I changed all the moving averages to bring them back in line to capture the movement of price during trends. Okay, you can see by going from that short one, and I'm going to bring it back up on the 3. And take it back off so we can just look at the 7. And notice that now in a uptrend, price stays above that 7. And in a downtrend, it tends to stay below that 7. In an uptrend above, it wasn't really an uptrend because it broke it, took 3 weeks to get back, and now it stayed above it. That's why my intermediate is designed that way on the upper right of a quadrant that only runs from the bottom left up to the top right, or from the top left down to the bottom right when a trend is in place. You need to match the moving average with whatever the asset is you're looking at. Stocks and indexes, individual stocks don't move the way indexes do. Individual stocks don't move the way mutual funds do. Individual stocks don't move the way Bitcoin does. And each one of them, you need to tailor Consensio for what you are looking at. This is not a difficult prospect. Simply do what I have just done. Get your short term to move through the middle of all the price activity. Get your intermediate term to stay in an uptrend below all the price activity. And stay above in a downtrend. Looking at longer periods, you can differentiate quickly between small corrections. This one lasted almost 6 weeks, which if you were living through it seemed like an eternity. But notice that none of those individual candles were completely below that red line. That's the way it's designed. If it doesn't work that way for the asset you are looking at, in this case, we're looking at an index of 30 stocks. When I move to 500 stocks in the S&P 500, or 2,000 in the Russell 2000, or 4,500 in what used to be called the Wilshire 5,000 Total Market Index, it has a different flavor because the speed with which the price gets from the bottom left to the upper right in a bull market, or the upper left to the bottom right in a bear market, differs by each asset class, sub-asset class. Okay, I promised myself I wouldn't go into portfolio theory and how I construct portfolios, but I see I'm going to need to do that at some point here before this hour is over, and we're still only got 30 minutes to go. So now what I'm going to do is I'm going to get out of the 7 and I'm going to pull up the long term. Now all of a sudden, what you're looking at is a line that very rarely in an uptrend shows price anywhere near it. The first one, the shortest one, went right through it and you couldn't even see it. The second one, the intermediate term, hugged the bottom and very rarely could price get below it, but it was a touch point all the way up. This monster only identifies real possible danger, and that's why it's designed lengthwise for this particular asset class, meaning a broad index, differently than I would use for other asset classes. Let's go back into time. And again, we're talking what is a trend? And we're talking about a trend is determined by the asset class. And a trend is overlaid with your definition of what you're trying to achieve as a speculator, a swing trader, a gambler, or an investor. You will notice that we went through a very difficult period in this trend when we took it back far enough you couldn't even tell. But this lasted basically when price finally broke here. It said something was wrong because there is an entire bar below the long-term moving average. By definition, I would have taken money off the table there, and we're going to get into that in detail in our last hour. How you position and how you use Consensio in general, and then specifically by asset class, all the way down to individual stocks. And we're going to look at about 50 individual stocks. And because of the time limits, we're going to do it quickly, but they're the ones that many of you have been asking us about and are concerned about. Okay, so I have said when we have looked at the Bitcoin charts, let's just forget what we're looking at. Let's take all the moving averages off and look at the price, and then let's take the price off and forget what it is. I know you all hate hearing it, but the more you hear it, the more I would like you to understand how important it is to me in every decision I make. Don't tell me what to buy. Tell me when to buy it. That's what a trend means. A trend has nothing to do with the asset class, Bitcoin or gold, a currency or a stock. It has to do with there are times to be long and times to be short. And there are times to just sit in a position that's going sideways. In this case, I would not have sold everything because the long-term moving average only flattened out. It actually went slightly down between this period and this period. But when you blow it up, and we will do that with a number of individual securities, you'll see what I mean. As long as this long-term moving average is moving up, this is by definition a bull market. This is by definition a bear market. It was not a significant bear market, but it lasted basically from May 2015 all the way until this point, even though the long-term moving average moved up. I say that because price did not make any headway between these 2 points. And this came in October, over a year later, a year and 4 months later. You could have used Consensio to get out of that whole thing. You would have been whipsawed, which means you would have had to jump out and then in. What you protected yourself against turned out not to be that big. By the time you got back in, you basically had lost a little bit on the downside and lost a little bit on the other side. You don't know that when this begins. You never can. Therefore, you've got to assume it's going to keep going in the direction that the long-term moving average is telling you. And in these cases, you've got to believe it's going to continue in the direction the long-term moving average is telling you. Okay, now I am going to put back this one and this one, and I am going to take off this one. Pretend you can't see what is up here in the upper left-hand corner. This is all you know. This is Consensio in its purest form. There is no price. Has anything changed? The answer is no, because each one of these lines has within it all of the price up to the point and going back either 2 periods or 7 periods or 30 periods. But all of that price, all of that noise, all of those ups and downs and big swings, wicks to the top, wicks to the bottom, closes in the middle, are gone, but these lines don't change. And these are the lines you need to understand with Bitcoin. Excuse me, with Consensio. What you want to do in using this analysis is let the lines speak for you. Don't tell me what to buy. Take the name off of it. Take the fundamentals out of it and see what everyone in the world, everyone, the smart ones, the big ones, the institutions, the individuals, the gamblers, the speculators, and the investors have voted on, because it's showing up in these 3 lines. What somebody says on television, what an analyst says on CNBC, what is written about in the Wall Street Journal or in Barron's or in IBD is unimportant. The only thing that's important for you is this is what is determining the value of your wealth. None of the other stuff is. Not the earnings, not the competition, not the margins, not the balance sheets, not the amount that's being mined or pumped out of the ground. None of that is. The only thing that matters is what is everyone in the world that is interested in this thing willing to pay for it? And what is the trend of that total usage of demand versus supply. Okay. With that, what we will do is we will look at some other charts, because we've only looked now at one, which is 30 stocks in an index called the Dow. And what I'm going to do is I'm going to move this all the way over to the beginning of this year. And we're first going to look at what the Dow is telling us about 2018. And what it tells me is, by looking only at the long-term moving average, is we were at the beginning, we have been ever since, we paused by going flat, and now we are in an uptrend again, right up through the close today at 4 o'clock. That's the long-term moving average. But notice what the short has done. It has cut through the intermediate term, and the intermediate term has turned down. Now I can throw the price back on, but you need to begin being able to picture where the price is when you look at these. You know the price has to be above these. In the pink line, I've already told you that the price is going to every week be somewhere along that pink line. Therefore, you can draw a mental picture of what price is doing there. You also know that this line is going to be in a bull market below the price most of the time, which tells you about what's happened here. You can't turn this pink line down unless the price has dropped below it. You can't turn this orange color or gold color down until the price has dropped below it. You can't get the pink line to go through this line unless the price is lower than that point at which they cross. And you can play around all day with the mathematics involved, but you should be able just to picture it anytime you look at a chart like this, even if you take the price off of it. What that does is it alleviates a lot of confusion that you will get from many, many other technical signals and many, many other fundamental opinions about what this thing is that you're looking at. Because I could put any name on this. I could put Bitcoin up in the upper left-hand corner, and I will find a time where Bitcoin looked exactly like this when you take the price away. And any other stock and any other index going back far enough in time. That's not what we're trying to do here. We're trying to understand the trend movement of these things. They all will move exactly the same because of the quadrant that we're in. It's limited in many ways, not just the ones I've described, but given enough thought, you will come up with a bunch of other things that these kind of financial charts can and cannot tell you. Okay, enough of that. Let's take a look at some other things. And to do that, I'm going to move this little baby down here, and I'm going to come up here, and I'm going to click on that. And I won't go to Bitcoin. I'm going to do that last. I'm going to go to the things that we're more interested in. Let's go to another index. Let's go to the NDX. Remember what we've just been looking at, the Dow Jones Industrial, made up of only 30 stocks. Now we're going to go to something that has 100 stocks in it. This is the NDX. The NDX 100, these are the 100 supposedly biggest stocks, they change every day, in the 2,000 some odd stocks in the NASDAQ. Now, we all know that certain stocks that make up these 100 are in deep trouble. And we're going to look at them later today. We're going to look at Netflix. We're going to look at Google. We're going to look at Apple. We're going to look at Amazon. But they're all in this chart. But so are 96 other companies. So I look at this chart and I say, wow, this is something I want to own as of today. Why? Because the trends are up. Yes, there was some noise earlier in the year. Oh, good, I get to hit my button. Boom, boom. There's noise in the beginning of the year. But notice that even though price might have, and let's just take a look for giggles, price might have dropped below the long-term moving average. Price might have dropped below the long-term moving average, but you're confusing yourself. Why do you want to confuse yourself? Get rid of it. Let the magic lines tell you the story. Simplify, simplify, simplify. Okay. So that's my reading on the NASDAQ 100 without knowing it's the NASDAQ 100. It ran into some problems earlier this year, but they were intermediate term problems. It turned the intermediate down. I raised cash. You know that if you've been listening to my vlogs. I said, yeah, we're raising 10% cash. We're raising 15% cash out of this thing. Because things began to happen and turn things down. But then we quickly got back in because what is this called? This is called a bull market. Short term above intermediate term above long term, and all three moving up. So why are you out of it? Okay. Let's go back into time, and the NASDAQ acts differently than the Dow 30. Here we're looking at 3 times the number of stocks, and they have characteristics that are different than the 30. Characteristics meaning they're different kinds of companies. And here you went through the same period of time sideways with the long-term moving average. Now, understand that if I right now change this long-term moving average to what some other people do, where they use 100-week moving average as opposed to my 30, or 200. And they use 200 because people use 250 and 14 or 250 and 20 across all charts in all time frames. You can't do that because I can make a moving average that is down here. And none of this came into play. So it's useless. Why have it? Now, it was very useful when you got back into earlier periods because it did turn the blue line down. And price broke down through it. But let's put price back on here on a longer time frame so you can really picture what I'm saying. There's the price. And here it is below the moving average. And here, depending on how you want to measure it, you get periods of time where it actually pulls that average down. And therefore, you should have taken defensive postures. You didn't know it was not going to go down here. But should you have ever sold 100%? I never would have. I didn't. I took defensive measures more extreme than these up here, because look at the difference between what we did to the long-term moving average there and there. Okay. Only 11 more minutes until we get into the usage of Consensio real time against many, many other asset classes, not just big indexes. The first one we looked at was the Dow that had 30. Now we've just looked at one that has 100. Now I'd like to take a look at one that has, well, let's do one with 500. This is the S&P 500. I've been saying that the NASDAQ 100, particularly the FANG stocks, many of which, if not all of which, are also in the S&P 500, was helping the S&P 500 to move up. But remember, on the ND axis, compared to the S&P 500, how quickly on the S&P 500, how slowly on the S&P 500 compared to the NASDAQ. This is 11th of June where we blew through. We were actually higher here on both the closing basis and the top of the wick compared to the old high. But somewhere in here on the NASDAQ 100, we had gone to new highs. On the S&P 500, we did not, nowhere close to it. It took us a long time before we hit this candle and finally really broke out again. That's the differential between having 500 companies and 100 companies and 30 companies, and the quality of the companies that make up each of them. That's where the fundamentals of what is the structure of the things you're looking at comes into play when you're using these moving averages, as opposed to the fundamentals about what makes these things go up and down, which this does not rely on at all. This is simply price. It's the only thing these moving averages are looking at. Notice there's no volume. We're not using any momentum indicators other than these three lines. We're not using stop and reverse points. We're not using McClellan oscillators, or we're not using RSIs. We're not using volume. But it's telling a complete story, and a very important one in terms of the beginning, the middle, and the end of moves, trend moves. Okay, so now we don't have price again. We've gone and we've looked at 500 stocks. Now let's, once again for giggles, look at a couple thousand. This is the entire NASDAQ composite. We came close here early in April, going back into time, where we know there were problems in the market back in 2015. You had the same problems here. Doesn't matter if you're looking at 30 stocks or 100 stocks or 500 stocks or a couple thousand stocks. The basic trends are the same. Where they occur, getting into and out of various positions varies by the asset class. Yes, it's true these are all stocks, but they're not the same indexes. They represent different things, and therefore you use each one separately depending on where your money is going into or what you're trying to get out of, positions you're trying to get out of. We'll put the price back on with this longer term view of the NASDAQ, just to show once again that the pink line stays with the price no matter where it goes. That's why I use the short term. It's an early warning. It's a canary in the coal mine. The intermediate term basically has price above it through up moves and below it through down moves. Above it and below it. That's what the intermediate term is designed to do. The long term ignores all of that and keeps you thinking as an investor in what the trend is telling you. Now, could next week change a lot of things? Of course it could. But next week has not happened. Wait for the evidence. You've got to wait until next Friday. Don't make your mind up on Monday, Tuesday, or Wednesday, which is a shorter term time period. That's not what you're measuring here with this trend. You're looking at this weekly move. You're trying to capture 80% of all upside movements, leaving 10% off the bottoms and leaving 10% off the tops and getting 80% in between. You can't do that if you jump all the way in and jump all the way out, even using Consensio. And you're going to run up big commission expenses if you do, which is one of the reasons I love mutual funds that doesn't cost you anything to jump in and out of. It will irritate the heck out of the mutual fund companies, and many of them will restrict you from jumping around too much. They are not vehicles for speculation or for gambling. But if you're managing billions of dollars using mutual funds, and you're looking for the long-term trends, which is what everybody needs to look at to make money over the long term, not jumping in and out and ignoring trends the way Edson Gould explained it, but catching the major part of the fact that for the last 100 years, all of these indexes have gone from the bottom left to the bottom the right of all the charts and still continue to do it right up through an hour ago. We've got about 4 minutes to go. I'm going to throw in one other thing that looks very different, which is the Russell 2000. And I say it looks very different, as you can see, because now we've got an entire candle for the week as of 2 hours ago below the long-term moving average. We didn't see that on any of the other charts. Notice also that the small cap stocks penetrated 6 different weeks here below that long-term moving average without turning it down. And here again for 4 weeks, and here again for a couple of weeks, and here for a very long period of time. You can see how severe this downturn was when you look at this particular sub-asset class, which is a part of the entire stock market, but it's just small companies between 500 million and $2 billion. They act differently. They are more volatile. When things like an asset class is more volatile than other things you are looking at, you need to look at them and change it. Change either the moving averages you're using to make sure the pink line stays in the middle of the pricing, which it does here. The intermediate term gets a little sloppy here, where the intermediate term very often is violated in small pullbacks. I would change on the Russell 2000 the length of time on the intermediate term, just glancing at this very quickly. Okay, we'll get into details of that in the next hour. So in the first hour, we talked in general about what the heck this thing is with these three wavy lines. And the three wavy lines we were using was price and two other moving averages. Now we've expanded it out to three moving averages in price in order to identify trends, short, intermediate, and long term, using big indexes. We're going to see how this changes tremendously when we look at things even more volatile, like Bitcoin, like individual stocks, like sectors, and like industries. And we will do that in a couple of minutes. And with that, I am going to clean this mess up and get back to what I want to talk about when I come back. And if anybody wants to take a little bit of a break, this is the time to do it. We will be back shortly. We'll take it back to about here. And we will take the price off once again because I don't care about the price. Okay. Am I muted?
You're good.
I'm good. Great. Oh, wow, that's neat. This shirt. Wow. Okay. We have covered the first two sections, and I want to see if I can figure this out. If I hit this little button, like that. Oh, good, that's not bad. And in these first two sections, wow, we've still got 100 people watching. Thank you all very much. We've taken the idea of what these lines are on this quadrant of a chart that we keep talking about. During the first section, we went through basic rules of Consensio in terms of what we're looking to do. You can construct it yourself very easily. All you need is a piece of paper and a pencil. It's easier to do it with charting so you don't have to do all the calculations. Just let this chart, or on Bitcoin Wisdom makes it very easy. The problem is you can only do a couple of cryptos and Bitcoin in general. But all the other charting places, Fidelity or E-Trade or any of the other ones, Schwab, gives you tools you can basically do this. And it's great to take it step by step. I think I've said that after Leah went to the class with Tone to learn the sequential trading system, that we spent some time together with on TradingView where we wouldn't put Tone's numbers on it, but I wanted Leah to do the calculations to figure out what those numbers are. The same thing in something like this. When you're hearing someone talk about it, you will understand or be able to picture certain things, and you'll go, oh, wow, I got that. And then 2 or 3 things later, it'll get fuzzy again. The way to unfuzz it is to actually do the calculations by hand on the moving averages. Take a simple moving average like a 10-day or 10-week or 10-month. It doesn't matter what the interval is, but do the calculations on it. And see when you plot on a 10-day moving average, what each of the 10 days do to the next point on the moving average. So you can begin to picture what these things are really saying. Each of those are calculated by a very, very simple formula, but when strung together into a line, which is called a moving average, you forget what it's really telling you until you can picture the calculations between shorter, intermediate, and long term. Why are they doing it the way they're doing it? You hear Tone all the time saying, here is when this moving average is going to turn down in the future. It's going to be 4 weeks from now. Well, all he's doing is counting back. If it's a 50-period moving average, counting back 50 weeks and seeing what is being dropped from the calculation compared to where it sits right today and what's going to be added on the next week. But that's because he really understands what he's doing. He doesn't have to calculate it. He pictures it. That's what you need to do for Consensio, is don't just go by the rules. I've given you some simple things, 13 on 2 moving averages against price, many hundreds when you add the third line, but they can be simplified in your mind in different ways the deeper you get into it. Just start using it and it'll start coming very easily to you. Okay, what we're going to talk about in this third period is we are going to go into very rapidly, because we have 70 some odd charts, which is less than 1 a minute. It doesn't matter, because remember, all you're going to do now is you're going to picture these lines, what they're telling you, relative to indexes. We just went through about 5. And now we're going to move into other groupings of securities, right down to individual securities. Okay, so I need to talk to you instead of show you. So I'm going to take this off again. Here is the way I construct portfolios for all of our consulting clients, all of my fiduciary clients. I break a portfolio into 3 parts. The first part is 60%. The second part is 25%. And the final part is 15%. 60% is made up of the charts we just looked at. Large, broad, diversified portfolios that relate or correlate to very big important things such as economies and overall stock markets. That can be done with indexes themselves in the form of mutual funds or ETFs, or it can be done by you putting together 50 or 75 different stocks into your own portfolio. If they're diversified enough, what they're going to do is they're going to reflect a much bigger story. If they're all tech stocks, they will not. They will only tell you what is happening in one sector of the stock market in the economy. So the 60% have got to be very broad and diversified, and it's much bigger than the other 2 piles. And the reason for that is we're investors. We are taking advantage of long-term trends in the economy and in businesses in the form of stocks and corporate profits. The next pile, 25%, is made up of sectors and industries that are either doing better than that diversified portfolio, and therefore will add to that diversified portfolio what's called alpha, or unexpected returns over and above what a big, heavy, diversified portfolio does. And you can do that, as we will see, sector by sector. 10 basic sectors, some people say 11, doesn't really matter. Each of those sectors are made up of industries. And I've used these examples before. In the financial sector, you've got insurance companies. They act differently than brokerage firms, that act differently than very large multinational banks, that act very different than regional banks. And each of those industries all go together to form that sector. You need to understand that when you're trying to identify things for this 25% bucket of your portfolio. Well, that's 85% of the portfolio. Now, the only thing that you are really risking in terms of moving away from investments and moving closer to speculation is the third bucket, where we only put individual stocks, or we put things like Bitcoin for now. And that's why I say over and over again, for clients that I'm actually managing their money, I will never be putting more than 5 or 10% in any of those one things, one stock, one asset like Bitcoin. In the 25% bucket, I might put 5 or 6 things in the same industry as individual stocks, because I've just made an industry that can fit into the 25% bucket. Okay. I needed to go through that to give you my perspective of what we're about to see. Now we have moved from the 60% bucket, and we're now going to move into the 25% bucket, sectors and industries, using the exact same technique and forgetting what we're looking at, just looking at the funny moving lines. Wow, I did it. Okay. So now what we need to do, this was the last chart we looked at, which was the Russell without the price. So now I've got to come up here and I am going to go to sectors. And these basically are just the big ugly sectors, and we'll start with this big ugly sector right here. Right here. Okay. Same time period as all the indexes we just looked at, the Dow, the S&P, the NASDAQ, Russell 2000. But now we're looking at consumer goods. Consumer goods, of course, are made up of many, many companies in many, many different industries. But they all fall in this general category called consumer goods. Very different picture. Same time frame, same 3, 7, and 30 moving averages. I'll flip price on just for a second, just so you can see I'm not cheating. Pink line, price stays right with it no matter where it goes. It warns you when you're going from up to down, when you're going from up to down, when you're going from up to down, and when you're going from down to up. It gives you early warning that things might be changing. Some speculators or gamblers, that's all they need. Remember, this is a 2-week moving average. Some people can bring these things down to 2 days or 2 hours or 2 15-minute periods, depending on what you are trying to achieve with that asset and if you're a gambler, a speculator, or an investor. Because I'm an investor, and I think that's where a very large portion of everybody's money needs to be at all times, regardless of what you do in the 25% bucket or the 15% bucket. That's what I am using in terms of my moving averages for this type of a thing. Now, also notice that the intermediate term also seems to be working well with this very volatile consumer goods group. Price in an uptrend stays above it. Price in a downtrend tends to stay below it, except for a couple of penetrations, but they don't last long. That tells you that the timing is good on this moving average with this particular asset. But what you're looking at now is something in which the long-term moving average topped and has been going down since March. It's still going down. We are now in a position in which the price is below the long-term moving average, which is below the intermediate term moving average, and the short-term moving average has cut down through both of them, and price is below it. This is a part of the US stock market that's in trouble. Let's go back. Remember what we looked at when we went back to the 2015 period. And let's take the price off again, because we don't care what we're looking at. We don't care what the name is. We just want to understand trends and trend changes. Going back far enough, we've got a pretty nice looking uptrend. It ran into problems when all those other things did, but then it ran into problems again to a much larger extent that the overall indexes did. And then got back in line for a year and a half, now is turned down again. The length of time that this long-term moving average has been moving down is greater than this one, is much more severe, but not in terms of time, but in the fact that this one is just going flat. And all the way back into 2013, we never had anything this bad. Now, in terms of how much you've given up, go sideways to see, did you buy here if you bought here, you haven't lost anything. You can get out, lick your wounds, and say, okay. If you bought anywhere previous to this, you've still got very large profits. What is this going to do in the future? For me, I don't care. I was out of a fairly large portion of this when this long-term moving average moved down. And particularly when these short and intermediate terms came this far below that long-term moving average. Look at the distance relative to this, relative to these little two things and these little blips. Something bigger is going on here. Now, what a fundamental analyst would do is he'd give you 25 reasons and pick out the 10 biggest stocks and look at their earnings and all that stuff. That's great. And I always do that after the fact, not before the fact. You try to understand this before it's done too much damage. We are moving from an uptrend into a downtrend. I don't want to hope that this downtrend turns around. I've already raised cash. What did I do with that cash? That's immaterial. We'll talk about it later in this hour. You don't want to be in this, you want to be in something that isn't going down and you know cash isn't going down. That's the starting place. Okay, let's back it up. Let's take a look at another one and move a little more quickly without all the verbiage. You understand what I'm trying to build here for you in terms of the mental picture of the difference between indexes and sectors. Now we're going to look at consumer services. Are you kidding me? How could two things with the word consumer in it be so different? The last one we looked at, you're getting your head handed to you. Consumer services, and what you need to do is you need to pull out your little book or Google it. Google the iShares US Consumer Service ETF and see what the stocks are in it. You'll see they're very different. You'll quickly be able to see, oh, they're in this industry and that industry. I don't care. If I was in this thing, I would still be in it. And at this point, I wouldn't have taken anything off the table. Some people would say, well, look, this has broken below the intermediate term. In some things, that's important to me, and I would have taken 5% off. I've got people in our consulting group that were talking this through specifically with real money that they've got put in, and they think because of what they're seeing in the NASDAQ and with certain stocks, that because this pink line is cutting through there and they own this particular thing, they need to raise cash. That's your call. In my case, I wouldn't be doing that because I've made conclusions about what the overall market's doing, and I don't really care about these little blips. What do these little blips look like in terms of price? Well, let's put the price back on. That's a big move, but that's a big move that only took you back to previous highs that were reached all the way back at the beginning of 2018. Now, this move this week looked pretty nasty, but look what happened. We came from below the long-term moving average to well above it and closed the week well above it, which means it's not going to turn this down. Now, if we stay down here next week, these are going to accelerate down and I'm going to raise cash. But not yet. Not for this particular thing. Okay. That's my interpretation of this thing that I've built. Everybody's got to get comfortable with their own moving averages. Do the test that I do. The pink should run through the price no matter where it goes. The intermediate term that you use, I'm using a 7-week in this case, stays below it when it's going up, quickly reverses when it's going down, and then stays above it while it's going up. Can be penetrated, but not too often. That's a nice fit. This one is telling me that we're still in an uptrend. Okay, until we're no longer in an uptrend because of stuff that starts happening up here in the days and weeks to come, we will revise that. If this spring back starts again on Monday, we're not going to have to worry about that question. Okay, now we're going to take the price off. Now we're going to change to energy, a very interesting and very volatile part of the Dow Jones, the S&P, the NASDAQ, and the Russell. It affects everything we do, but now we've broken this out of the indexes and we're only looking at this as a standalone. This happens to be the IYEs, which is the iShares US Energy ETF. You can look it up, see who's in it. But this is some pretty wild swings compared to everything we've looked at, including indexes. It will get a lot wilder as we look at other things. But notice that it bears no resemblance to any of the charts we've looked at. Here is the downturn that we had in 2014 and 2015 that was basically a flattening of everything we've looked at. This thing started down all the way here, clearly was in a bear market and had struggled for a long period of time to get out of it. It gave you little periods of hope that when you see this happening, you know that price is going up, above, below, above. Then it tried to get going and was actually in a mini bull market with these above each other, but quickly came to an end and then collapsed again, over and over again. Therefore, it's a very important difference from other sectors when trying to diversify a portfolio. You either want to be out of this thing because it's a drag on what you're trying to achieve, and you've already got all these stocks in the big indexes. To a portfolio, when this is happening as a sector, counter to what everything else is doing in bull markets and indexes, but you're being weighed down by this sector, is you want to have puts or go short the iShares US Energy against your portfolio. What that does is it negates the stocks you've already got in your portfolio in various big indexes. And we will do a vlog. It won't take a whole webinar, but we'll just do a vlog on that subject that you can use as you go from big indexes to smaller indexes, the smaller indexes to offset things going on in the bigger index by going on the opposite side of that trade. When you move out of, excuse me, indexes into sectors, you can find sectors that are doing better than the indexes, and you want to buy them to add value to your 60% out of your 25%. You're using that to eliminate risk and to increase return in the 60%. And by doing that properly, you have increased your portfolio to 85% of X, whatever it is, in your retirement account, your personal account. You've just integrated Consensio's work into the building of a portfolio that is better than simply buying and holding an index. Okay, very important points, but we don't have a lot of time and we've got lots of charts to look at. So that's energy. I want to now look at financials. This is the financial sector, which is made up of all the other industries I've already named. And it had been doing extremely well, meaning that at the end of last year, the short and intermediate term moving averages were way above the long-term moving averages, which means we've got to look at price to understand why would that be. And this is why it would be, because basically we ran from 120 up to 140, 20 on 40 in a very short period of 2 months. But ever since then, we've gone flat, not only with price, but notice how all the moving averages have come together and are going sideways. We tried to break out for a very short period of time. We did not get back up to these highs. And now things are rolling over. And this is not a good looking candle compared to all the other candles we've looked at, except the first consumer one we looked at. This entire candle this week has been below the long-term moving average. The short-term moving average is now cut through the long-term. Financials are not the place to be. It is not in a full-blown bear market, and it's so important for all the other sectors that this has got to get you to sit up and think a little bit more about what the big indexes are telling you, particularly because the big indexes are being controlled by large cap growth, mainly in technology, mainly with a dozen stocks. This sector is much broader. It's all the brokerage firms, all the banks, all the small banks, the big banks, the insurance companies. Everything is thrown into this. You need to break it apart when you get down to the industry level. Let's take it back and see how it looks as you get into the corrections in 2014 and 15. Very long, protracted sideways movement with prices above, below, above, below, above, below, over and over again, a downturn, and finally a great bull market. I'm going to take the price off, and I want to analyze why you would have gotten back into this regardless of what this thing is called. If you take the price off, you look at this activity, you're in it as long as the blue line is going up and these other things are coming down and touching it and hitting it and touching it and hitting it, but then quickly bounce back above it. Now here in this period, you go into a bear market. It did not last long. Let's call it from early fall of 2015 until the summer of 2016, you're in a bear market. You should have either been out during that 9-month period or shorted this sector against the other sectors that were all going up in the form of the indexes to take the sting out of those indexes. So they're not weighed down by the fact that they've got these things in them that are pulling you down. By just taking one option, one put, you can offset a very large portion of that. We'll talk about in more detail. But now let's look at getting back in. Going from a trend that was up to flat to down, when would you get back in this using Consensio? Well, go back to when you examine the first part that we talked about. Take a look at when the short-term moving average moves up. Take a look when the intermediate term moves up, and why is it moving up here? Well, you know price is up here somewhere. That's the only way you get the short and intermediate term to move up. So price is up here, and now this keeps going up and up and up, and both of them cross through the long-term moving average, which is doing what? It's still moving down. It's not time to get in. It's time to take off the puts, though. But what happens is the short term quickly turns down again. Let's take a quick look at price and figure out why that happened. It happened because this little 1, 2, 3, 4, 5 Elliott impulse off the bottom ran out of gas, and we quickly dropped back below everything. Quickly reestablished in terms of price right here. We didn't know that because we're not looking at price, because we don't care. Don't tell me what to buy. Tell me when to buy it. And the when is when all three of these are back in line and the long term is moving up. You don't need to know where the price is. This chart just tells you where the price is. The long term cannot move up unless the price is back above it. And you've already gotten a hint because of the canary in the coal mine, which is now hitting highs, above highs, above highs, above highs. That's why you've got a short-term moving average. You want to be able to get in and out before the damage is done in increments. Okay, so that's the US financials right up through today. Let's move it back so we don't have a clue of what these things are telling us, and let's move to healthcare. No questions here. Long-term bull market, and it's accelerating to the upside right up through the end of today. We don't know what the price is. We don't know what we're looking at, but we know we want to be in it. Let's go back and see if that's been true and for how long it's been true. Well, here is a problem that did not show up in many of the indexes, and that's going into 2017, long after the 2014-2015 problems. And if we take it back even further, we see basically we went through a very prolonged period that started at the same time that everything else, including indexes and the other sectors we looked at, ran into problems. This one did, and it kept it up and then gave you a false move up that then flattened out. You can figure yourself by pulling this up, if you use TradingView, go through these charts the way I am, take off the names and all the rest, and figure out when and how you would have gone in and out and what kind of percentages you would have wanted to do it with. But you do know that right here, without looking at price, you want to be fully in this again. I said, looking at the very recent term, we've got some problems, and here's why. This sharp drop down, and I don't care which stocks did it or what the story was or what was in the newspapers. All I know is that the stocks that made up this iShares US Healthcare ETF, 1 or 2 or 5 or 10 of them, tumbled enough to bring the short and intermediate term down below the long term, but did not turn the long term down. That's very important. You should never have been out of 100% of this, but you should have lightened up your position with this, meaning the short term breaking below the long term, and definitely when the intermediate term broke below the long term. How much? 5% on each of those moves, 10% on each of those moves, maybe. But the long term was still moving up when those first two things occurred. So not a whole lot more than that. I would have probably done those 2 5s, and I would have thrown in a 10 on top of it, or 20% altogether when we broke through the long-term moving average. The fact that both of these then bottomed out with the canary in the coal mine first, as it should and always will, and quickly cutting back through the intermediate term and shortly thereafter through the long term, you're back in with this crossover. You've taken your cash out. It cost you a little bit, nickels and dimes against what you were trying to do. That's the way you use Consensio. But it is matched up to the underlying asset class. These are industrials. You've heard over and over again that been having a lot of problems. It doesn't show up on this chart other than the flattening out of the long term. This is worrisome, but we're still way along from that. I'm not even going to look at the price. You can picture it in your head now if you've been paying attention, which all of you are, and I'm thankful for that. Let's go back just to take a quick look at 15 and 16, same stuff, same thing you saw before. You get back in after the long term has moved up. All three of them are doing the right thing. Each of the moving averages is doing well. We came down here briefly, did not last long enough to take anything off the table. Ran into the problems we just looked at. Okay, don't need price. I don't care what it is. I just care what the trend is. And are the moving averages doing what they're supposed to do relative to the utilities? A lot of people are talking a lot about utilities, mainly because of what we've seen here and here. Relative to all the other charts we just looked at, utilities pay big dividends. Utilities tend to be very defensive relative to other things, but you need to prove that to yourself. Don't just mimic it because you've heard other people say it. One way to prove it is assume that this probably hasn't done as well as some of the other sectors. Well, that assumption is wrong. It's done terrifically well. However, it keeps causing the long-term moving average to flatten out, roll over shortly, roll over, and we didn't see that action in almost any of the other things we saw. So this has a different flavor. Enough of a flavor that we need to take a look at the price and see what is happening that would cause that. And this is where cycles come in. And a lot of people have been talking on CNBC and other things, and this is where Edson Gould really caught on. He did a lot of work with utilities, but just notice we go over 1, 2, 3 bars. We go over 1, 2, 3 bars, 3 bars, 3 bars down, 1, 2, 3, halfway, 1, 2, 3, top, 1, 2, 3, down, 1, 2, 3, 1, 2, 3, up. There is something cyclical going on with this that if you study it, if you take the price away and forget that what you're looking at is this thing called utilities, and just look at the moving average, the longer term, and take a look at the distance between these periods. Here doubled, never got below it, but you got a sideways correction at the midpoint, and then the next top, then the next top, and then the next top. You can try to figure out why the cycle works like that. You can look over decades going back and get a good sense of it. More importantly, you want to break it down into the stocks, see what kind of utilities we're talking about. Is it just some of them? Is it all of them? And in that way, going forward, whenever utilities come up on your radar as something to either protect an account in which everything else is doing the opposite thing without having to buy puts, you can hide in things like this, which since the summer has been moving up and clearly has not moved down nearly as much as the big indexes in most of the other sectors. Okay, we are at 42 minutes and I am way behind, so I've got to speed this up. And we're ready to do that. I'm not going to do the last one. Maybe I will, maybe I lied. This is telecommunications. Yeah, let's just take a real quick look. There you go. Been in a downturn all the way for a year and a half. Actually broke out of the downturn recently. We don't know what this is. We don't know what the name of it is. We take away the price. And this is all you need to know. You needed to be hedging all of your other pieces against this because this is in all of your other pieces and it's a drag on your returns. 1 or 2 puts would have done it for you, but you should have taken those puts off, put them on things like the consumers we just looked at, and maybe even bought calls or doubled up on this position because it is holding up so well relative to your 60% and relative to your 25% in other sectors and other industries. And with that, we are going to go to individual stocks. And we've got a lot of them. And I just want you to look at, in the next 15 minutes, this end of the chart, because this is going to answer a lot of your questions about what a lot of these things are doing. I need to move this down to here. I need to go up to this one. This is Tesla. What is Tesla doing right now? It's in a bear market, period. We don't know it's Tesla. I don't care what the price is doing. Now, I'm not going to go into the analysis of why I think this might hold these levels. That's a different topic. It's company specific. It's Bitcoin specific. It's one piece of the 15% of your portfolio that you've got to go beyond what Consensio is telling you. You've got to bring in many other indicators and many other things. If you go back far enough on Tesla, you will see that at the 250 level, there's tremendous support. You will also see that if you connect these lows with these, that there's tremendous support at 250. So if you hadn't bought it, I would wait for it to hold at 250. If you are in it, I wouldn't panic out of it unless it closes below 250. That's all I'm going to say about that. That is not advice. That is telling you that when you move from the 60% bucket into the 25% bucket and all the way down into the 15% bucket, you're going to get wild volatility that's going to take a lot more analysis and a lot more of your time, but the starting place should always be Consensio. Now let's take a look at Amazon. Is Amazon in trouble? Nope. That's all you need to know. Google. Is Google in trouble? Maybe. These are coming down very quickly, but the long-term moving average has flattened. How can that happen unless price of whatever this thing is, which we don't know because we don't care, has dropped below it? You knew that had to happen without knowing this was Google and without looking at the price, because you can't flatten a long-term out unless price is below it. Let's look at Facebook. Is it in trouble? Yes. Let's look at Apple. Is it in trouble? No. When I say is it in trouble, I mean, should you be worrying about it? Should you be jumping out of it? Should you be reducing exposure to other things because of what is happening in the news or what someone is saying, selling their book on television or in the newspapers or in the media? There is no reason to worry about this chart. You are in a long-term uptrend. Microsoft, long-term uptrend. Cisco, long-term uptrend. Little more volatility. Take a closer look by going back further. Try to figure out if this is significant. Comcast, trouble. If you're in it, you shouldn't be. You wouldn't be if you were using Consensio. That's not enough. We're talking about 15% of your portfolio. Hopefully, only 1 or 2% is in something like this. You got caught, you went on vacation. It's a long vacation. You've been gone since the beginning of 2018. You didn't care because you had all this other stuff in the 60% and the 25%. You didn't have to look at it. We're looking at individual stocks, things like Bitcoin, things that move very rapidly, sometimes individual mining shares, individual oil companies. This is FedEx. The reason I put this on here is because FedEx tends to be a leading indicator of the US economy. It tells you what Amazon is doing, but it tells you what is being shipped, how many goods, how many services. And it peaked back here. And you've got tops below tops below tops on the moving averages. And things are beginning to look nasty. I don't need to show the price. You know what it has to do to turn price down. You know where the price is. Don't marry yourself to the name or the price. This is Intel. Looked awfully good until recently. It does not look good now. And you know why. You can write down all the reasons without looking back, without putting price on. Netflix. Very surprising. Very surprising because we have people that are shorting it and making money. How can you be shorting it and making money with this kind of action? Okay. I said I wouldn't do it, but I'm going to because this is important. At various times, you need to use other sorts of indicators. The indicator we're using here, even though Consensio hasn't given you the signal you need yet, is because this is a hyperwave. This is phase 4 of a hyperwave. This is phase 5 and you are out. This is come all the way down to here. This is phase 6. You've covered your shorts or you've hedged your shorts. You might have even played this long. It has now run out of gas and it's coming back down. Is it too early to say that this is going all the way back down to the bottom of this chart? Maybe. That's for a hyperwave discussion. We are debating it. Some people are playing it in our hyperwave group and have done very well, but it's not an easy thing to do, particularly when Consensio is so far behind the curve on this. Trying to find out why it is. It's not the pink line. That's working perfectly. It's not the orange or gold line because that's working perfectly, meaning in uptrends, prices above it, downtrends, it's below it. So it's got to have something to do with the long-term trend being too far away from the action. We didn't know that though, but we did have another tool, and that's why you use other tools. This one is called Hyperwave, and it gave us signals. And each technical indicator you will learn gives you more information than other ones under various circumstances. What I have found is Hyperwave always is the most important of all the technical signals you can get, and it overrides all the other ones. Okay, enough of that. We're going to move this back up. And we are going to go on to square. Still looking good. This is nasty. We broke down through the long term. We're closing well above it. Would I be taking some money off of it? Probably not. Would you? Probably or maybe. That's up to you. You understand what the implications are. Put in the context, this is 15% of a portfolio. If you've got 15% of your money in this one thing, then absolutely you want to lighten up on it. It's your whole speculative piece of the whole pie, and it's not looking perfect. If you've got 1% of your money in it, and you've got 14 other things in the 15% bucket, you've got plenty of time because everything else you're still doing well in. Okay, that's the way you look at the sizing, is just what I went through. Okay, let's go to Micron Technology. Very interesting. It's just turned negative as opposed to a lot of the other things we've seen. We know where the price has got to be. It is now in a full bear market. AT&T, it's been in a bear market for a long time. But guess what? Just like the utilities, something funny is happening here at the end. It's time to explore that. A Biomed, no comment. You can tell. BlackRock, very important chart because of the size and the influence of BlackRock. No comment. You know as much as I do until you look further. NVIDIA, no problem, except this is very interesting to me. Without looking at price and knowing what we're looking at, we are in a bull market, but how in the world did that flatten out? You know the answer to it. You can't flatten out unless the price is below that moving average. We didn't need to look. You knew that. I'm not saying be ignorant. I'm not saying you've got all those other tools, all kinds of other technical stuff. Of course you're going to look at price. What I'm saying is you don't need to, and you will draw the same conclusions with this very simple system. Visa, no problem. Very interesting. These are the marijuana stocks. This is CanTrust. It does not correlate to anything we've looked at before. It has not been around very long. How do you know that? Because this is where the long-term moving average starts. That means it wasn't around long enough. This is called a FRIA, also a marijuana stock. This is CGC, also a marijuana stock. We have just defined an industry by looking at 3 stocks. Those 3 stocks could be in your 25% bucket as an industry under agriculture. And under agriculture, small piece called marijuana, smaller piece called medical marijuana that is only wholesale to pharmaceutical companies. But what I'm telling you is don't get married just to the idea of a stock. When Consensio gives you clues that several stocks in the same grouping are doing something differently that can help the overall portfolio, particularly when that overall portfolio is going through a difficult time, things like this can be a stopgap measure. Somebody asked me if I wouldn't bring this up. This is the last one we're looking at because we've still got a couple of minutes. This is General Electric. Are you kidding me? If you've been in this at all, you have been. If you were in the Dow Jones, you are no longer because it was taken out of the Dow Jones, but it's definitely in the S&P 500 and it's in like every other index. Doesn't correlate to anything. You are out here. You have been out ever since. I'm not going to try in today to answer when do you get back into something like that. You can hear all the fundamentals. You can hear about the new CEO. You can hear about the outgoing one. You can hear about the great CEOs that were around before. You can look at all the numbers in terms of profits and growth and sales and revenue and margins. Or you can wait for a simple signal that will get you back in long before this thing starts moving up again. And with that, I am through. I've got less than a minute to go. I want to thank everybody that stuck with us. I'm going to stop sharing, but I can pull up any of the things we just talked about. We've still got 100 people. You people are fools. This is a Friday night, and you're sitting there. Hopefully all you're doing is, well, thank you very much. We are honored to have you. Thank you, Leah, for getting this all set up. Thank you, Tone, for helping us along the way. This is a big day for us. We have gone outside of our comfort zone of the last 7 or 8 months. And so far, I really like what we've seen. So hopefully, we're going to do many, many more of these. And we would like any and all of you to let us know what subjects that you've heard us talk about or that you have not, that you would like more in-depth analysis to help you put into perspective some of the things I've been talking about. And with that, I believe I can just sit here and all of the work is going to become my partner. She does all the work before and after and in between. And chat is got a lot of stuff in it, a lot of questions. Okay.
All right, you ready, Ty? No need for any crazy music in between?
Well, yeah, we better not.
I had another ZZ Top song for you. All right. So just so you know, you got 39 questions. So sorry, everybody, but I am going to have to pick and choose some of these.
I bet it's the same guy over and over again or the same girl.
Or them.
Right.
Yeah. Okay. How do you choose which cross to trigger a buy sell? Do you just act on each one, or is there some decision criteria? One, yep.
Yeah, excellent question, because I didn't go into the details. We ran out of time. But what I tried to do along the way is give you the sense that if you're looking at the 60% bucket or the 25% bucket or the 15% bucket, which again is going from the more conservative, broadly diversified, easily tracked, longer-term trends, less volatility, to the next level, which breaks all of that up into 10 basic pieces. Each of those 10 pieces are broken into anywhere from 3 or 4 to 20 sub-pieces. That's the group called 25%, which are sectors and industries. The answer to your question is, it depends on if you're talking about the 60% or the 25%. And within the 25%, it depends on which one you are talking about. Remember, we looked at all 10 of them. And 2 or 3 of them were very different. They were more volatile. They were going in opposite directions. Therefore, when a cross takes place between price and a short-term moving average or price and an intermediate-term moving average, put in perspective the implications of what it's telling you about your whole portfolio. That does not work for people that are trading 3 things and putting a lot of money in each of those 3 things, because there's little or no interaction between the 3. That's why I spent as much time as I did talking about building a portfolio. I don't mean a trading portfolio. I mean a portfolio of all your wealth, your retirement accounts, your real estate, your stocks, your bonds, your crypto, your cash, your paintings, your racehorses, your numismatic coins, your Chinese ceramics, your furniture, the house you live in, other real estate that you don't live in, but it's investment property. All of that together is your wealth. Whenever you decide you're going to take money from riskless cash and put into any of the things I just said, you can use Consensio to give you clues about the timing of what you're doing. So let's just stick to the things we talked about, which are stocks, bonds, and cash. We didn't talk about bonds. We were going to, because it's a very important element of fundamentally what's going on with these stocks. And we didn't look at Bitcoin, and we didn't look at, but we will do that during this question and answer period. I'm going to pull up the Bitcoin chart just as we did, and I'm going to pull up GBTC's chart and tell you why you should have gotten in when you should have last year, when you should have gotten out using not Hyperwave, just Consensio, and why you should still not be in this market. But so my answer is there is no answer that fits all the situations. I've given you as best as I could the way I look at them in terms of stocks in very large groupings called diversified portfolios, in stocks in smaller groupings and smaller groupings, meaning sectors and industries and individual stocks. You want to react more quickly at this end of the spectrum, more slowly at this end of the spectrum, because you don't have to worry on these broadly diversified things about pieces going wild over short periods of time. You do as you get into the areas of more volatility, particularly things like Bitcoin or gold mining shares or gold or mining shares in general when they are company specific. Okay, so that's the best I can do to answer that. I cannot give you a formula that works across everything you're going to do, but you can figure it all out, and it's very easy. Just look at the charts the way I did, then go back and find periods that the thing you're looking at had problems before, and compare it to where you are now, and make your own decision of what that's telling you and how much you want to get out.
I know I was muted. Thanks, Ty. Is there some way to determine the strength or weakness of an impulse or trend line? The angle of ascent, hold on. The angle of ascent is difficult to ascertain since it will depend on the compression of the timeline.
Yeah, absolutely. Time is important. The reason I don't like exponential, I don't like logarithmic, I can't visualize them the way I can the simpler. Simplify, simplify, simplify. You hear that in everything I do. And a lot of people think it's because I'm not smart enough to be able to go up to the next step or the next step. And that might well be the case. And I'm not trying to be disingenuous or humble. I mean, the people's minds work differently. People picture things differently. I resolve everything in my mind, ideas down into pictures, things into metaphors and aphorisms and similes. That's just what I do. And so charts are the same way. You can make it as complex as possible or as simple as possible. I always move towards the simpler side. Okay. If you compress time or compress price, it's going to change angles because of everything I said earlier in the first part of this in terms of what happens in the quadrant that's plus plus starting at 0, what you can do on that chart. So why in the world would you blow that apart by going exponential or exponential moving averages or using logarithmic charts? You want to be able to visualize this period compared to previous periods. As soon as you use a log chart, it's true you can look at more going back and it doesn't, it evens things out. but it also loses a tremendous amount in my interpretations of it. I can't just look at it and draw conclusions, whereas I can with what we just went through. Now, your question about the angles of lines is very complicated. I said to begin with that a horizontal line is stronger than an angular line, but that depends on not so much the steepness of the angle, which can be affected by moving the timeline or the price line or both, but it has to do just with the fact that the only way you get an angle, and now I've got to talk hyperwave because it's one of the few things that looks at the angular lines, angular trend lines in this particular fashion, that says for some odd reason that I don't have the answer for, when you break out of a phase one, you go up at a certain angle, and then that angle will accelerate 2 more times above it. It won't do it one time and then lower its angle. It will keep getting steeper and steeper. That tells you something about the essence of what this thing is. It's called a bubble, or is called a blow-off, or is called a hyperwave, depending on how you define those things. A hyperwave is far more specific than bubbles and blow-offs. It gives you far many more clues, but it has to do with the 3 phases after phase 1, 2, 3, and 4, going up at steeper and steeper angles. And now the only other thing I'm going to say is on the other side of the top, after you've hit a 4 and you're going 5, 6, and 7, things change dramatically relative to those angles. The angles don't matter much. And the final angle, the 7th angle, doesn't matter at all. The phase 7. That's why I differ on tone on his drawing of phase 7 on Bitcoin and mine. A phase 7 can constantly move. I'm not sure which way you're looking at it, but a phase 7 will fan out further and further from left to right, the longer it takes to get back to the phase 1 or become a funky hyperwave at 2 or 3. It does not tell you anything if price breaks above the phase 7 that you had before. That is not indicative of any change. You are still going down to the 3 and then the 2 and then finally the phase 1 again. That's not true with any other angle, any other of those lines. Hyperwave, but that's a different story. But it's important to understand the answer to your question is it depends. It depends on what the angle is, and is it coming off of another angle, or is it a new angle that just began and is going up at a different level? And then, yes, you can play with the time, you can play with the price, and you can see that that angle will change over longer and longer time periods, lower and lower, in short time periods, higher and higher. It's work to do any of this stuff, and I oversimplify it, but I think it was important talking about this Consensio concept.
Thanks, Ty. I think your grandson is extremely excited.
Yeah, he is. It's
yeah. Oh, okay. So is Consensio useful for taking short positions? If so, are the entry points the same as the exit points from a long position on the downturn?
No. Yes. Next question. No, the no part of the answer is it is not the same. Whenever you talk about being long or short, it's not the same thing. And I talked about that mathematically in terms of your wealth, meaning that buying and selling is not the same thing in terms of what it does. Most people think of it as 50-50, and it is not. I want to be out of an uptrending market early. I want to be in cash in a downtrending market late. I want the evidence to be that the trend has changed. I'm not going to guess that it's going to change. I'm not going to put money to work when I'm in cash on the belief that a new bull market is starting. I will leave a lot on the table at the beginning of the move because I'd rather be in cash. I don't want to eat into principal. At the top, I'm not in cash. Therefore, I make different decisions going from long positions to short much more quickly than I do from cash into long positions or getting out of hedges or getting out of shorts going into long positions. You need to weigh that yourself, but think of what that means. Now, that also is true about if you're going to short something using Consensio. If you're a trader, you can use Consensio to time your trades. And depending on if you want to do it when the short term turns down or the intermediate, or the short crosses the intermediate, or they both cross the long term, is dependent on how short of a time frame you're looking at, as opposed to longer time frames. I've said over and over, I'm only interested in long-term trends. And very few people fall into that category. And therefore, out of the 100 listening, very few of you do. You're looking at other things, so you need to make up your own mind.
You've mentioned that you're ideally making only a few trades a year. Doesn't Consensio force you into making many trades if the signals come up?
No, not at all. Depending on how long your moving averages are and what they're set to do. I told you that my son, who is just here, and Leah's brother, helped us build a Consensio trading system for ETFs 15 years ago, or 12 years ago, 13 years ago, that only traded every tick of the market hundreds of times a day on 125 ETFs, where we were long or short every one of those ETFs at all times. And Consensio works wonderfully for that. That's a hedge fund, and it's set up differently. And we knew statistically how many would be long and how many would be short, which then evens out the risk of the overall portfolio as long as you stay in all of it. I had a partner back in the late 1970s, early 80s, where we did the same thing using a Wells Wilder system in commodities, where we were long or short 30 different commodities every day, all the time, and our portfolio was those 30 things. But we use broadening tops and broadening bottoms, what we call the Selgin system, to make those trades. Now, depending if you're trading day trades, second by second, tick by tick with ETFs, or longer term swing trades, which what a broadening top and broadening bottom are in the commodity market, or long-term trades on diversified portfolios of mutual funds or ETFs, that will determine the number of trades you have, not Consensio. Now, obviously, we were using minute charts on the ETFs. I'm using weekly charts on these long-term trends, and my 30-week moving average is the one that really signals my trades, although I'll take some off the table. So in a 10-year bull market, we had very, very few trades. You saw on a couple of instances where we would have taken a little money off the table. That's very different than jumping in and out and in and out and in and out. And if you're using no-load mutual funds, there are no commissions. There are taxes unless you're using retirement accounts. So we're trying to go through all of those pieces, but you need to put it all together to understand what Consensio is really telling you. You're in control of the trading, not the system. Ouch, I've got a cramp. Okay.
In the 2000 tech bubble, how far behind the NASDAQ in percentage would we have been before Consensio flagged to sell?
It's a great question, and I am going to do a screen share because that's a specific question to a specific time. And that means what we will do is we will get off specific stocks and we will go to where did they go? Oh, here they are. It's okay, I found them. Okay, indexes. And now we are going to do, I'm going to do the NASDAQ 100 back then, which is made up of different stocks. Oh, wow. I don't know if I can go back that far on this particular template that we've got. I'm sure we can. I can if I do monthly. I'm going to cheat. I'm going to go monthly. And on the monthlies, I can go back to 2000. There it is. We weren't using monthlies. We were using weeklies. What happens if I turn this to a weekly? I think I lose the time.
It should work, Ty.
No, it never does for me.
Let's try.
Boom. See, it jumps the time period because the template's different. Somebody there knows, and maybe they can tell Leah a way to do it, but that's okay. Let's pretend. I can do it by doing the moving averages. Okay, these are monthlies. So the moving averages, we've got to go much, much longer.
Well, Ty,
Yes.
we have an answer. Thank you, Jerry. If you
Great.
switch just at the top, the NDX, the ticker, and switch it to IXIC, then you can do your weekly. Up top left where the big cursor thingy is.
Up top, which, right or left?
Left.
Up top left. Switch this ticker.
Keep going.
This ticker.
Boom, yeah.
Really?
Yeah, apparently.
But the IXIC, did you say the IXIC, which is the overall NASDAQ?
Yep.
That was what the question was? Well, I could, okay.
Try IXIC. Jerry, you're in big trouble if this isn't it.
Big trouble, Jerry. Okay, IXIC, boom.
Okay, try weekly.
Now you say try weekly. Oh, wow. I've got geniuses in my, well, wait, too early to, nope, doesn't do it. It's because I built this template. All of my charts are exactly the same, and so I would need to come up here and do some funny stuff. So I'm sorry. I can't give you the answer to that. I will tell you we got out very early. We got out very early of the NASDAQ using Consensio because as I've said, I use other things. One of the things I used was Hyperwave. Hyperwave got us out very early, long before the other indexes turned down. This also would have gotten us out, but remember what happened with the NASDAQ in 1999, going to that peak we just looked at on a monthly basis. I'm going back to the monthly because by going to the monthly, I can take it all the way back. This is the monthly. This is an 88% move in the index. That means that the price, which I will now put on top of it, show price, show, boom, went vertical. Here is your phase 4, 3, 4, 5 down, 6 back up through the Consensio lines and then came all the way down through it all. But on a weekly basis, you would picture that these moving averages crossed very quickly because this intermediate term. I would not, I'm just looking quickly, the pink is staying right with the price as it should. The intermediate was staying above the price. I'm assuming for a second this wasn't a hyperwave, so I didn't have other tools to use. I would have taken stuff off the table here because we had crosses of prices in intermediates and short terms. You would have gotten out at 3,000 when the long term moved down. That was way too late. You gave back way too much. You needed other tools. Thank the Lord for hyperwave. That's such an unusual move. In 06, 07, 08, 09, we missed all of the downturn by using a number of different indicators, but including this one. This is monthly, so we're going to go back to weekly and look at the second example. And you can see the breaking right up here in terms of price at 5,000 of both the intermediate and the short term below the long term. And notice that the long term went flat for a very long period of time, even though price had dropped very sharply down before this run up. This is 2016, and this doesn't go back far enough. Again, we use the monthly. Sorry. Okay. Sorry about that.
Ready?
Yep.
Okay. Can you talk through the expected steps to take to enter Bitcoin once Consensio starts going through its confirmation stages of bullish reversal?
Great. I was hoping for that question, and that means we want to share and pull up Bitcoin, which I promised I would do. So to do that, I've got to go to these magic boxes. I hate magic boxes. And somewhere here we've got Bitcoin. There it is. And so we will start with Bitcoin. And we will do the weeklies, but we will shorten it down to 2018. And we've got the same moving averages. I've got a 3 instead of a 2. And the 3 is too long, but we'll take it. I should be using a 2 because this is a 7-day week, and therefore we only want 14 days as opposed to what we were looking at with the stocks. But in any case, we've got the price below the intermediate term and below the short term, and we've got the short term below the intermediate term and below the long term. We are in a bear market. Now, on a couple of occasions, we have broken above and started these short-term bounces. We've had a total, I count this as 1. I count this as 2, I count this as 3, I count this as 4, I count this as 5, and now I count this as 6. 6 times, each one highs, below highs, below highs. But on each of those run-ups from this tremendous horizontal line that I said in the first part of our meeting today is the strongest of all lines, stronger than trend lines going this way or trend lines going this way, unless they're phase lines of a hyperwave. Phase lines of a hyperwave are the strongest of all angular trend lines. Okay, so the question was, how would we do it? Well, these are weeklies, so let's drop down to dailies. If you're trying to buy something that's been falling for a long time and you're sure that it's going up at some point, drop down on your time frame using Consensio, because it's going to be much more sensitive to turns. This turn, for example, happened a month ago, going way, way up, but then quickly going way, way down, where price breaks sharply below both the short-term and intermediate term. Doesn't get all the way down to the long term, but it didn't really matter because of the steepness of what was going on, blew through the long term and turned the long term from flat back to down again, even on the short term. So my answer to you would be, on Bitcoin, once we get down to where we're going, which, as you know, I believe is a lot lower than we are now, and I could be right or wrong, Tone could be right or wrong, you could be right or wrong, but Consensio will not be. It will be right. So use it as a timing tool, and you can drop down again if you want to. If you're really thinking this is someplace you want to be, drop down to the 4-hour chart using Consensio. This is a 4-period chart now. And what is this one telling you? Oops, we just dropped to 61.82. Okay, what this is telling you is we're still in a bear market, but on a very short time frame, we flattened out again. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, let's call it. So 40 hours, a little over a day long, and we flattened out once again. As we keep pointing out, is the tendency of this thing to do on all of those snapbacks. The snapbacks and these flattening out periods, both on the upside and the downside. And those are important. And you can catch them with Consensio if you're a short-term trader. I wouldn't be buying this one, although we're so far below the moving average, which in this case, again, is 4-hour moving average, that we're starting here to look like we're going to do something. The short-term moving price first goes first, then the short-term cuts through the intermediate term. The intermediate term tries to turn up, but actually runs out of gas. And now, of course, everything's turning down, and quickly everything will be dropping lower. If price comes back up so that it turns these around, we have the possibility of a short-term bounce up somewhere, meeting this long-term moving average coming up again. That's the way I would play it down at the 1,000 mark. That's the way I would play it at the 5,000 mark, the 4,800 zone up to the 5,400, soon to be 5,500 zone in terms of Bitcoin using hyperwave analysis and other forms of analysis. But you see how easy it is to, and again, forget it's Bitcoin, forget your predilection for what this thing is. We're only talking about timing, about moving cash in or out of something. Is this the time on a short-term basis for a speculator to be buying whatever this thing is? Yeah, I think it is. Without looking at the price, we got the short term stop going down, rolling over. The intermediate term has stopped going down, is flat, but the short term moved above it, which means price is doing something up here. And we got quite a bit of room to go where you can go from 6,100, you can pick up $300 on a $6,000 or a 5% kind of a move on an unleveraged basis. That's a decent thing. Am I going to do it? Of course not, because the longer time frames say this is nowhere near what it needs to do to turn anything significantly around, including, you know, the day chart and the weekly chart. Just nowhere near it, not even considering it. Down, 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 bear, bear, bear. Wait for it, depending on the kind of a trader you are. I want to pull up GBTC just real quick and just see if there's anything anybody sees here differently than me. Let's go back to Bitcoin. We're looking at weekly charts. We've got a flattening out of Bitcoin, which means that opportunity for a pop back looked pretty good. We are not getting a flattening out of GBTC, as my last calculation showed it having no premium whatsoever, back down to zero. I actually showed it on a short-term basis with a discount. Depends on how you calculate it. I know I calculate it differently than the folks at GBTC on their website. I think mine's more accurate. In any case, what I've been saying all along is that I believe GBTC leads both up and down the price of Bitcoin. And I have no takers on that theory, but I am wed to it. And right now it's working correctly, doing exactly what I would expect. But it also means that Bitcoin should be breaking down here pretty quickly. Okay, I'm stopping sharing, and let's go to the next one. And we are at 6:34, so I've got 30 minutes. And thank 87 of you for still being with us.
All right. Can you use the VIX as a driver for a decision formula on what moving averages to use on the S&P 500?
I have no idea. It's a great question. We just don't have the firepower or the time at this point. Hopefully that's going to change during the next year, and more about that later. But it's a great question, something that tells you short-term movements like the VIX that can be applied to not only big indexes, but a lot of other things, not just the S&P, but can help you. Many technical tools can help you in conjunction with other tools. I showed you one example when we looked at the NASDAQ back in 2000 in terms of marrying this with hyperwave. If you can't marry it with hyperwave, you can marry it with all the other things you've seen me talk about, SARs and RSIs and MACDs, McClellan oscillator, all of those things can help you frame what you need to do at a point in time relative to how big, how long or short your moving averages should be. But I wanted to keep this as simple as possible.
Are there ratios for moving averages relative to time frames that works well?
Yes, and you could probably figure those out from some of the things I told you today about the three that I like to use, not in terms of time, but in terms of the effect with the asset class. Just be sure that your short one is running through all the prices in both directions. And price doesn't get very far above it or very far beneath it at any point. Then you know your short term is right. 2 might not be right for a lot of things. 3 might not be right. 4 might not be right. On the intermediate term, I think you can do the same thing. It's the long term that's the biggest problem. If you try to fit the longer term to price activity, you're getting too close and you're going to get a lot of false signals. The biggest problem with longer term moving averages is in most cases when you see people using them, the price is so far above them in a bull market and so far below them in a bear market that it renders them meaningless. It doesn't give you, you want to get out as quickly as you can. You don't want to get out too many times on false moves. You want to balance those two things. And if you can do that by using any other technique to help you, then you will do much better.
Can you share with us an example of money management using Consensio? Example, like how you are going to raise cash percentages during a trend shift?
Yes, I can, but rather than show anything, let's just think about it together in terms of what I actually do as a discretionary manager for the accounts that I manage. That's one group of people. The second group of people are people that Lee and I are consulting with, in which we will give our recommendations, but each individual makes their own decisions which and how much of those recommendations to take. Anyone that takes other than what I have recommended, either more or less, more aggressive or less aggressive, is doing something differently than I am doing for my clients, where I've got full control over the buying and selling. And on those clients that I've got full control over the buying and selling, we're not discussing what we're doing, why we're doing it, when I'm doing it. I go by the 60, 25, 15 rule, and I stick with that. And in each of those buckets, I use different time frames on Consensio because they're measuring more and more volatile buckets. But they mean less and less to the overall portfolio as they get more aggressive because the size of the positions relative to the other positions. All of that enters into the money management side. Entering and exiting positions using just Consensio at tops and bottoms. I've already said over and over again today and in every vlog, and I try in the tweets, which is very difficult to do because you can't say very much, that there is a big difference between taking money that's in cash and putting it to work as opposed to taking money out of things and putting it into cash. You don't use the same decisions. I don't use them when I manage money. If I've been very defensive and I have totally hedged all of my accounts out of risk in the stock market, which I did back in 07, 08, 09, I am not going to go by what Consensio tells me about putting that cash back to work. I'll be reluctant. I will lengthen the times. I will be patient. Why? I'm sitting in cash. I have no risk. So people say, what you're saying is you're losing opportunity on the upside. You bet I am. 100% of the time. I'll do it every time. On the other side of the equation, when I'm fully invested like I am now, until I raised a small amount in the small cap and in the NASDAQ, particularly in the NASDAQ 100, because of the activity we just looked at. It did not affect the other broad averages, but they are broad averages in themselves, and they were problematic, so I took a little bit, meaning 5% pieces out of it. It would have been 10% out of it if we didn't have strength in all the other areas and the economy wasn't strong in all the others. So I'm taking the risk for my clients by staying with a long-term trend. But I'm taking some of the risk off the table as things begin to happen. And we're in the middle of that. That's why it's so important we're doing this today. But I want out of those positions as soon as I've got an excuse to get out. And if it takes one by one of things breaking down, I will accelerate what I am doing, because what's happening is more and more evidence is coming in that this is a broader and broader decline, which is going to affect all three parts of my portfolio. So even though I'm tiptoeing into getting out, you will see me moving very quickly next week or the following week as and if more evidence comes in that this is bigger than it looks like. So I want to be completely out before we've given up 10% in the portfolio. We were able to achieve that in 07, 08, 09, where most clients ended up with very minor losses over the full time period of time. Very minor, meaning less than 10, because that's what the goal was over the entire portfolio. And that's my goal today, and will be 20 years from now, and was 20 years before that, but I couldn't do it because the clients I had there were big institutional clients that wouldn't let me have that much flexibility to protect them from the downturn in 2001, 2, and 3. So I was forced to stay in the market, but make very drastic shifts between growth and value, between mid cap and large cap, and totally out of technology. And that helped a lot. And over the 5-year period from 1998 to 2003, in institutional money management, we were named one of the top 0.1% of all equity managers in the country for that 5-year period of time, following all the rules that the consultants and the trustees and the institutions placed upon us. But I swore I would never go through that again, where I am responsible for their money, but they've hand-tied me in order from using these tools. I wasn't in 07, 8, and 9 because I no longer managed institutional money. It was just individual money. Long answer, but all of it is important in understanding the question about how you would use Consensio, practically speaking, getting into or out of positions as trends are changing. It depends on all of those things I just said.
Thanks, Dad. This is a comment. I just moved it. And the question's at the end. It makes sense to use Consensio to get out of assets in bear markets and switch to other assets who are in bull markets according to Consensio. This way, cash can do something useful while asset X is in bear market. Trick is figuring out which of all potential bull market assets to choose. Question: what variables come into play when evaluating this transfer from asset to asset?
Great question, and one that will take an entire webinar to explain. But in short, you just saw me go through a number of indexes at the same period of time that we looked at sectors, which were all parts of those indexes. And we began to see things that were strong and things that were weak by looking at the sectors that we could not see by just looking at the indexes, because they were hidden in those indexes along with a lot of other stuff, right? So the first thing is you need to divide your assets up, understanding what goes into those assets. Then what we did is we broke the sectors down into industries. Why? Because each sector is made up of 4 or 5 or 10 or 20 industries, only one of which might be so powerful in the opposite direction that it's affecting the overall sector. But now by going industry by industry, we know that. And within each of those industries, as I mentioned, like in regional banks, you've got large regional banks, you've got mid-sized regional banks, and you've got small regional banks. You've got ones that are growth-oriented and others that are value-oriented relative to their price to book. So what I'm telling you is that what you want to do is different as you go from everything being bad, which rarely happens, to everything being good, which rarely happens. The difference between those two things is everything good, which rarely happens, you don't need to use anything. Just sit back and enjoy it. Don't try to switch from this to that. Go on vacation, relax. But not on the other scenario. This is what Edson Gould said. This is why John Bogle and Vanguard and buy and hold is wrong. You never want to have your assets in something like Bitcoin all the time, regardless of all these signals that I've been talking about. And you certainly don't want all your wealth, all your retirement account, to go into a period like 07, 8, and 9, or what I believe we are going to see in the future, and hopefully it's in the far future. But it's coming. because of all the fundamental problems we've talked about. So the question is, how do you pick which thing to be in? Well, it depends on what time frame you're in. You don't want to be in anything when everything is bad, which is very rare. The 1920s, absolutely. 1970s, no. The 1970s, the stock market didn't go anywhere, but anything that was inflation driven, like commodities, like oil, like gold, like silver, that's the only thing you needed to be in. And you could take your pick. You couldn't do that back in the 20s. You could do it in the 70s. Now fast forward to what we saw in the 1999, 2000, all the way up to 2010. The stock market was not a good place to be, but you had two chances. One is to get out for the first 3 years. One was to get in for the next 3 years. One to get out for the next 3 years, and you've eaten up that 10-year period, basically just making 3 decisions. One is to get out in 2000. One is to get in 2003. One is to get out in late 2007. And then there was a fourth that occurred when you wanted to get back in. Knowing, looking back over that 10-year period, you haven't made any money. What you did is you lost money, you made money, you lost money, net, net, net. You had a wasted decade. Using Consensio, you could have gotten out, gotten in, gotten out, and gotten in, and done very well. So that's why I say it's a very complicated question, and that's about the simplest answer I can give you at this point.
Where does gold fit in the 25% or in the 15% of the portfolio?
Great question, because both gold and Bitcoin belong in the 15%. So does silver, because they're all single things. But I've told all of my clients, all our consulting clients, that when we get to a bottom in Bitcoin, when we get to a bottom in gold, when we got to the top in gold, that I look at those things differently because of everything you've heard me say about macroeconomics. The stock market in general is designated in US dollars, and the stock market is, in general, more responsive to the overall economic picture than any of these sub-assets are. But both gold and Bitcoin have the ability to take a major role at various times in controlling all macro finance. Bitcoin's nowhere near it, but I believe it has the fundamental ability to do it. And because of that, I am more than willing to recommend to clients to steal from that 15% pot and put it into the 25% pot, and even put those two pots together for both gold and for Bitcoin, which is a huge percentage of an overall portfolio. But I would never take from the 60% to get into either of them. I would personally, but not for people I'm consulting with or people I'm managing their money for.
All right, Ty. It's 6:52. What do you think?
Wow, you guys are amazing. Thank you so much for the interest, unless you left 3 hours ago but just left your computers on, which I would not blame you for. But really, thank you. Thank you for all the questions. Thank you for all the interest. Leah, thank you for everything you did to get this set up. Tone, thank you very much for everything you've brought to this entire ecosystem and will continue to do. Yeah, why not? Tone just in the last couple of days has announced a big deal that's going to happen. Take a look at it. It's called unconfiscatable.com. You can go through tonevase.com, but look at unconfiscatable.com. See what he's up to. It's going to be a lot of fun. And Leah and I are going to, for the first time, present hyperwave in great detail during the conference. The second time, I did it 20 years ago, and that's how a number of things happened, but I quickly shut that down because I needed to use it and keep it proprietary. We've decided not to, and because it's so important for Bitcoin. That's how I got into this space, because Leah called me up and said, we need to do this, not just because of hyperwave, but all this other stuff we're beginning to talk about that will help people not only in the crypto space, but hopefully on a much broader basis. But it'll be fun to meet everybody there. It's going to be an incredible 3 or 4 days with tournaments, poker tournaments, with talks by some terrific people. Take a look at it. I highly recommend it. And I dropped everything and said, yep, Tone, absolutely. We'll do this. He hopes to do this every year. I think it's going to become a very big deal, and it should, because it is talking about Bitcoin. We are going to have a lot of non-Bitcoiners there that are crypto related, and they're going to be sitting around the poker tables with us. We are going to have a fascinating couple of days of discussions. It will be a lot of fun for everybody. So Lee and I fully endorse it, and it's we're looking forward to it.
Yeah. Wait, Tyler.
Really appreciate it. Yeah.
Ty, well, since we're ending with thank yous, and we had your son come in for a little computer check, we can mention one last time that it was him that found the Bitcoin hyperwave.
Absolutely, he was. He called me April of last year. He knows all about hyperwave. He and Leah's brother, Ben, set up Lucid Investment Strategies 10 years ago. They originally owned 90% of it. Now I got 10%. They set up something that is going terrifically well in Chattanooga called verypossible.com. But they both know everything about Consensio, everything about hyperwave. And my son called me up April of last year and said, Dad, take a look at Bitcoin. I think it's in a hyperwave. And everything we've done is because of that call, including us benefiting greatly on the upside during 2017 and getting out at the top in 2018. And we hope a lot of you are going to come along with us for this next ride. It's going to be a doozy.
All right, everybody. Thank you so much for watching. Thanks, Ty.
Thank you, everybody. Bye-bye.